Happy evening to all of you. Welcome to today's CPE meeting on Company Audit 22-23, all you need to know. We have with us Jomon K. George, past chairman SIRC of ICAI. May now request sir to come and occupy the dais, please. Please give him a big round of applause. We will start today's proceedings with the invocation of ICAI motto song. All are requested to raise for ICAI motto as a mark of respect to our mother institute.
Yaeshasupteshu jagrati Yaeshasupteshu jagrati Kamam 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 sho nirvimanaha tadev shukram brahma Asmin lokaha asmin loshah sarve kaduna kashchana etadvaita
Thank you. Please be seated. It's my privilege to introduce the speaker for today, Jomon K. George. He is a fellow member of our institute with 30 years of diversified practice experience. Was the chairman of SIRC of ICAI during the period 2019-20. During his chairmanship, SIRC has bagged Commendable Achievement Award by ICAI. He is the founder and managing partner of JBR and Associates, an 8-partner firm specializing in corporate audits and consultancy. He is the mentor of Philip Macmillan Woods, a multidisciplinary accounting and consulting firm based in Dubai. During his chairmanship, we used to wonder him as he frequently shuttles between Kerala and India, as if going to the shop next door. He is a faculty for auditing at the Institute of Chartered Accountants of India, has taught more than 10,000 chartered accountants. A big round of applause for that, sir. A regular resource person on professional circuit on accounting and auditing standards and corporate audit, has done more than 900 presentations so far. He is also a peer reviewer trainer. He was a member of Auditing and Assurance Standard Board of ICAI, was the chairman of ICAI Ernakulam branch of SIRC of ICAI during the period 2002 and 2003. He has travelled extensively to United Kingdom, Middle East and the Far East. He was the past president of Rotary Cochin Central and member of various social clubs, Honorable Treasurer, Regional Sports Centre Kochi, former Secretary, Kerala Management Association, member Advisory Board, St. Teresa's College, Ernakulam, authored a book, Trials Pinpatakal, Reflections of a Personal and Professional Life, released in February 2021. He is a corporate trainer, columnist and panelist. During his chairmanship, whenever he visits SIRC office, he never fails to address the MCS students and motivate them. He is a great motivator too. His communication in the English language is very good and commendable. I think Sarah has inherited that talent from his mother, who was an English professor. With this brief, I have great pleasure in presenting before you a great learned personality and a seasoned gentleman, CA Jomon K. George. Over to you, sir. Before I hand over the proceedings to sir, may I now request CA Devadas sir to come forward and present a shawl and memento to Jomon K. George as a token of our love and affection. Take care of your steps, sir.
Excuse me, sir.
Over to German K. George, sir.
Going back. Respected senior members, fellow colleagues, the staff team headed by Rahman, Shivani and others, warm good evening to all of you. I'm extremely happy to be back in Chennai. I was here when Chennai was Madras. I did my articles way back from 88 to 91 in Chennai. I'm so happy that my matchmate Sri Kumar is here. It is a pleasant coincidence. He's now a senior manager with at the regional office of South Indian Bank. Thank you, Sri Kumar. We call him Kutan fondly to have you here. Also, my old friend, we were reading room mates, Mr. Malcolm Joseph. I'm very, very happy that I'm back in Chennai. I always say Chennai is second home for me. And after doing articles, then I came back in 2012 as an elected regional council member and was fortunate to become the chairman of the region in 1920. So Chennai has always pleasant memories. When you come by flight, when you land, you see the buildings and get to reminisce old days. When you're coming by train, Basin Bridge is like, I'm almost reaching home. It's a great feeling. And even when I was chairman, when I was eligible for flight travel, sometimes prefer to travel by train to the old feeling. It was those time it was in the sometimes unreserved second class compartment when you travel at short notice. But now it is slightly different. It's an AC compartment, that's only different. So like somebody said, senior theatre person came here for a Sikasa function, theatre person, I forgot his name. So he said, Madras, where the senior members will surely relish this, what I'm going to say now. Madras is an emotion and Chennai is a city. So I have experienced both Madras and Chennai. And my office used to be on Cathedral Road. Our office used to be on Cathedral Road. So half of the period of my articles, it was Jayalalitha who was the CEO. And then it was Karnataka or the other way around. So at this Gopalapuram or Poyas Garden, we used to get held up in the traffic block, standing in the hot sun on my second-hand Bajaj Chetak scooter. A lot of pleasant memories. So I was staying in SIRC put me in Savera Hotel. So Radhakrishna Salai, Cathedral Road, all that, every inch of it brings me a lot of memories. I'm happy that we would get together. With the topic being so important, frankly speaking, I was expecting a slightly larger audience. Nevertheless, we'll get started. Today is a working day, and everyone has now started after the personal tax filing. Everyone's already started the tax filing, the tax audits already, and they're in the midst of audits. But every one of us is doing company audits, and therefore the update on Company Act and provisions relating to company audit is really very, very important. And I'm also happy that some of the students are there. You are the future of the profession, and November 23, if you're writing final, there'll be a lot of questions from what we're going to discuss today. That's CSR 135, NAFRA 132, Schedule 3 revised, CARO 2020. All those things are very important. So, in hoping to have more members in the audience, not for the sake of an audience, because of the importance of the topic, let me move on to the specifics of the topic. Thanking my chairman, Panaraj, with whom I was in 2 councils, the SIRC chairman, Secretary Arun, and all of them who invited me for this program. We'll move on to the specifics of the topic. And as Rahman rightly said, it is captioned as Company Audit 22-23, all you need to know in about next 2 hours, time and mood permits, and then we'll round up most of the important things which are relevant for 22-23 audit. But frankly, 22-23, if you ask me, there are not many changes in this year of audit. The real year of change was 21-22, where we had Schedule 3 amended, CARO 2020 came into existence after deferring it from 2020, 21, and finally in 21-22 they made CARO 2020 applicable. So that was a huge year of change. So in today's presentation, I think we are going to check whether we did it right or not in 21-22. And if yes, we'll continue that. And if not, we'll try to improve upon the presentation that we help our clients to do, the reporting that we do. And today, while saying that, I should also be reminding every one of you that those who are using WhatsApp, all of you are using, I was not. When I was SIRC chairman, I was not on social media. I was forced to later for another professional reason. So you're getting messages every day on action being taken against erring auditors. It could be the MCA, it could be the NAFRA, and NAFRA is really flexing its muscle. NAFRA for larger companies, but for chartered accounts in Chennai, I'm sure most of you are associated with companies where NAFRA has jurisdiction and authority. And even for not getting, I don't know whether you read that yesterday, the DC, Disciplinary Committee of the Institute, has taken action against a member for not getting external confirmations for receivables. And he has been debarred for 3 months with the penalty of 1 lakh. I'm not creating a scare at the, initiating this discussion, but at the same time, one has to be aware that the regulatory environment that we work is substantially more stringent, and they are looking at the profession with a lot of suspicion, including our DC, but some external agencies like MCA or NAFRA. And not without reason, if you ask me, since this is a closed door discussion. Many of our members have been doing audits very passively. Tax, income tax, GST, all that have taken center stage, but those who are doing company audit, lot of changes have happened. Ever since 2013 Act has been enacted. It was 56 Act, and then after so many years that we came out with 13 Act, which is still not a settled law. Even after 10 years, Companies Act 23 is not a settled piece of enactment. We still have the Company Law Committee which is working on so many things which we know as decriminalizing the Companies Act 23. The provisions are, some of the provisions are very punitive. Penalties running into crores, imprisonment of more than 6 months. We call it free food and accommodation for more than 6 months, and so on it goes. So, on the one side, this has been enacted in a haste, and today India is being looked upon as a favored investment destination. From across the globe, global investors are coming in. Chip factories of Apple and all that. So there are a lot of things in Chennai. Tamil Nadu is quite happening. Ease of doing business, our neighboring states, Andhra is one and I think Telangana is 2. So there's a term called ABC, I don't know whether you have heard this. The Davos round came out because of China's too aggressive attitude. Globally there's a feeling, they say it's called ABC, anything but China. So the people are looking at investing in places like India, but small teeny tots like Vietnam and all that getting a huge share of global investment. And here when we are welcoming our PM or our minister's team going abroad and inviting them to India, saying that this is a new saga of enterprise called India, where you can do business and do well, we have good technology, we have good infrastructure, of course, way to go. But then the biggest problem is that are our laws still so draconian? Our laws are so difficult to comply, it will scare away the investors. Therefore, there's a need to substantially simplify, rectify, rationalize. There's a tax law, there's GST, and of course the Companies Act, which is the master act as far as corporates functioning in the country are concerned. So ease of doing business is the most important concern now. So for enhancing ease of doing business, reducing cost of compliance, particularly for smaller companies, the act is still being tinkered around and made a lot of changes in it. But while saying this, I should also say that the amendment which has happened to Schedule 3 last year, and of course the demanding requirements like Arrow 2020 are slightly against the spirit. It's putting lot of additional responsibilities on small companies. Companies, I say, because technically speaking, the preparation of financial statements have to be done by the companies, right? Theoretically speaking. But in practice, it's the other way around. I've been introduced as teaching for 20 long years. So in the first class on auditing, we used to say that auditing starts where accounting ends. But in practice, 31 years into my practice, I've started feeling that serious year-end accounting starts only after the auditor makes a call to the corporate, not even the corporate, the accountant of the corporate. Am I right? Many of you are smiling, so the scene is not different in Chennai. But it's Cochin, Chennai, Mumbai, London, Paris, New York, it doesn't make any difference. It is the same because corporate accountants most of the time tend to think that our job is over when earlier days we used to say, well, trial balance is tallied. Nowadays, Sri Kumar would recall that nowadays we used to wonder how can a trial balance tally? Now it's the other way around. How can trial balance not tally? The first 6 months of our articles, we were carrying ledgers this thick. I developed a lot of muscles, Stigma too, and then we were doing casting, posting, and tallying trial balances. Today, technology has advanced so much that everything is taken care of, but embedded in that could be very, very dangerous underlying irregularities, misstatements, including frauds. So that's the situation. So the corporate accountant puts even the listed space. My experience in Kerala has been that even the listed space, if there are corporate accountants, I'm not belittling you anyway, but saying that majority of them, think that aging analysis is the auditor's job. Calculation of depreciation here is the auditor's job. Inventory verification and valuation is the auditor's job. And we should slowly rise up and say that sorry, this is not our job. You have to do your part. Even in C&AG audits, I feel that our members are yielding too much to the corporates. And that invites trouble. And for that to change, one is a mindset change, two is that a good awareness of what are the latest things which are happening in the sphere of corporate audit. So with this, let me move on to the specifics more. The key aspects as far as corporate audit is concerned, or put it this way, there's a very well-defined statutory framework in Chapter 10. Chapter 10 of the Companies Act 2013. Sections 139 to 148 is Chapter 10, Audit and Auditors. We'll discuss that in detail. I'm happy that you're noting down. Professional pronouncements. For the corporate accountant sitting at this side of the table, we have accounting standards for smaller companies and Ind AS for bigger companies. They have to comply with that. Again, that is on us. And we had a statute, we had a Kerala PSU audit last year, 21-22, where it came as a shock for them that when we told them that Schedule 3 has been amended. There's a cost accountant who is the CFO, there's a company secretary qualified, there's a chartered accountant who is internal auditor, in-house internal auditor, but they were not aware. And finally it ended up that we issued an adverse opinion, not a qualified opinion, adverse opinion. The financial statements do not give a true and fair view. And that's how the story goes. So here the professional pronouncements, here this side is accounting standards in Ind AS, and for the auditors, can the students help me? And for the auditors, which are the professional pronouncements? Standards on auditing. Companies Act still calls it auditing standards. If you look at section 143, I'm coming to that a little later, the caption, the name of the section itself has auditing standards in it. So that's very broad. So professional pronouncements would encompass accounting standards, Ind AS, and standards on auditing. And lastly, specific reporting requirements. I'm referring to what is required to be reported under 143.3 subsections, many of them, including fraud reporting 143.12. Then CARO, which is emanating from 143.11. Then of course IFC reporting, internal financial control reporting for larger companies. Many of us are not aware about it. IFC has now been reframed by the Institute as ICOFA. That's what Big Four used to set down. Internal controls over financial reporting. Because the Institute felt, and the profession also felt that asking the auditor to give a report on the whole government of internal controls, including operational controls, are beyond the domain of chartered accountants. Therefore, we should be asked only to comment on the internal controls over financial reporting. That's the thinking. The focus areas, I would put it this way. The paramount thing in accounting and auditing is to bring about and ensure true and fair. Now, what constitutes true and fair, all of us know. The financial statement should be devoid of material omissions, material misstatements, frauds, irregularities, fair valuation, compliance with standards, and so many things which we talk about. So that is very, very important, true and fair. Then the next one is the format of financial statements. If you look at Accounting Standard 1, Disclosure of Accounting Policies, it talks of, there's a term called substance over form. It states that it is not just not merely the legal form what matters, it is the contents which are really going into that is what really matters. So then today, with Schedule 3 formats becoming so complex and so demanding, with so much of disclosures, the legal form has also got its importance. Because in the auditor's report, we are reporting whether the financial statements give all the information in the manner so required in the main body of the report. The students may be thinking that who reads the auditor's report? We take a printout from the previous year, just change year, and we are done with that. The earlier people used to say, sir, don't worry, nobody is reading the auditor's report, you write whatever you want. But today, the shareholders are informed, they are reading the auditor's report. The regulator is reading the auditor's report. The income tax department is going to the notes on accounts. I'm sure some of you will remember that when this related party disclosures, AS8 became mandatory, and we started disclosing transactions with key managerial personnel, KMP and directors. The income tax department asked a few of their assistants, clerks, to flip through annual reports and find out if there's a debit balance, closing debit balance in the director's account. And issue notice for what? 222E, which is a deemed dividend. I'm not a tax person. I hope what I said is right. If directors have drawn money and there's a debit balance in the account, to the extent of the accumulated profits the company has, if they have significant 20% holding, etc., they can be taxed as deemed dividend, 222E. I moved away from tax practice about 12 years back. For the reason, today larger firms, partners in larger firms, I see that everyone is doing everything. And the specialization does not happen. So I would be very unhappy if in Cochin last week we had a presentation, August 2nd we had a presentation on a similar topic where I presented, we had a capacity crowd. So where I found that 3 partners of the same firm come for a company audit seminar, that personally and professionally make me very unhappy. Why 3, only 1? For a GST, all the 3 will go again. Why? There should be a GST partner. Of course, we cannot be watertight, but I think high time that we started specializing and verticalizing our practice. And I think in my firm, we have done it with some success. I can very happily say that the partner in charge of audit and assurance cannot form a company, cannot incorporate a company, doesn't know. And the compliance partner doesn't do any major audits. And I don't get into GST at all. There's an old story which talks about, I'm supposed to be the founder and the senior partner. I've finished 31 years of my practice. This is a very, I would say, a very interesting story. A person goes to a pet shop and he wanted to buy this Australian parrots, the colorful big parrots. So there are a few of them, 3 of them actually. So he asked him, how much is this parrot? He said, $100. $100 for a parrot, what is that capable of doing? I is very good at accounting and auditing. So $100. And then the second one is $200. Why? Because he is not interested in the past. He is good at making business plans, valuations and all that. $200. And that one, slightly disinterested parrot looking outside and all that. They say, what is that capable of doing for $500? Frankly speaking, I have not seen him doing a damn thing, but the other 2 parrots call him senior partner. So I said, first, I call myself a senior partner, so I hope you will take it in the right spirit. So when you become a senior partner, you don't have to do anything. That's what specialization is all about. So coming back, the format we completed, and then first, that's where we strayed from. Accounting standard complaints. Now, there's so many accounting standards, so many days, and true and fair will not happen. True and fair will be vitiated. True and fair will not be achieved, accomplished, unless we comply with all the applicable standards. How many standards, if I ask the audience or we introspect, we have our own doubts. All that will be cleared as we go by in the next 1.5 to 2 hours. Internal controls. Evaluation of internal controls is something in larger audits at least. It's a very, very important audit exercise. And also we have the ICAI, Internal Financial Control Reporting requirement for some companies. We will see all are exempted. Small companies are of course exempted, and there's other limits also. Finally, informed reporting. Informed reporting is what I said, because it cannot be a copy-paste from the previous year. You have to look at the auditor's report very, very carefully. Every line of it, every sentence of it, every figure which is going into the auditor's report. And today we have tabular form, undisputed amounts, spending, and before which forum it's spending, KAM, key audit matters in listed companies and so on. And lastly, the biggest challenge, or rather what we must, I say 3 times, we must do is that All the audits should be done in compliance with standards and audit. Because they're part of the statute book now. They're not just, I'll come to that a little later. So this is how I put the focus areas as. And this, whoever is reading the Companies Act today, I would strongly suggest that you do only e-reading. Go to the MCA website, mca.gov.in, and then the Companies Act 2013, the e-book, which is administered by the ICAI. That is where you get the latest version, latest updated version of the Companies Act. I said it is very dynamic, it's changing every day. If you read a book, like we used to have the Ramaya, senior members would know. The glittering Ramaya is still in our shelf. And then the new version of the Ramaya was a blue wrapper, blue cover, and the other one is still as, we would treasure that. And 10 years from now, the students would ask, what the hell is this? Because they don't read any more of the thick books. It's all quick reference on e-reading. E-reading is good. When you travel by flight, you see people using a Kindle and reading, not that they read books. So therefore, this is the most important. And of course, there are publications which comes with a combination of the Act, the regulations, and practice notes. That we can of course refer. But the final reference to double check should be the Companies Act e-book, which is on the website of the MCA, mca.gov.in. Section 139, the fonts are a little small. I mean, it's a screenshot from I have taken. 139, appointment, 140, removal, resignation, 141, eligibility, qualifications, disqualifications, 142, remuneration, that's also very important. We are selling cheap. I have some time permits towards the end of the presentation. Look at 140, that's the most important section, powers and duties of auditors and auditing standards. The section itself says what auditing standards. We'll come to that, the importance of. 144 is something everyone has to be aware of. It is a prohibition for the statutory auditor to render multidisciplinary services. You know how Sarbanes-Oxley Act came in the US after the Enron collapse and all that. Here it is saying that the statutory auditor, I can do any service to a corporate client of SIRC because I'm not a statutory auditor. The moment you're a statutory auditor, you're not supposed to give management services. Attestation we can do, tax audit we can do, but GST filing, those kind of services we are prohibited from doing. But we are doing it obliviously. We are doing it. Sometimes internal audits, internal control advisory. All those things we are helping them. That is prohibited under 144. 145 is not a very important section. It is signing the auditor's report, attending general meeting, punishment for contravention, and lastly post-audit 148. What's new? Not for this year. Actually, these are major changes which happened in mandatory nature of auditing standards. The third bullet point was there right from 2013. We are 10 years into the new regime, but still we are not applying it. The FRRB findings, the Financial Reporting Review Board of our institute. If you look at the second edition of their findings, the hard copy, the soft copy is available on the institute website. The complaints with the standards, complaints of the members of the institute with the standards issued by the institute are dismally poor. Very, very poorly complained with. Awareness is poor. That's because, again, the specialization is not coming. I'm coming to that point. We are too much into tax. And CA profession, majority of us have pledged corporate law practice to company secretaries. Why did we do that? And a lot of opportunities from registration to compliances, audits. There are a lot of things which are good opportunities, which is again knowledge opportunity plus lucrative commercially also. So mandatory nature of auditing standard we leave it, and here is Schedule 3 revised format, which is there from last year. I hope all of you are familiar, and it emanates from section 129, that is about financial statements. The old act it is section 211, here it is 129. What is 128 incidentally, can the students tell me? 128 also changes come. That is the last bullet point. 128 deals with books of accounts. Logically, sequentially, 129 deals with financial statements. And I mentioned about Schedule 10 in the previous slide, right? Yeah, chapter 10 I mentioned in the case of audits. But when it comes to accounting for the corporate auditor, for the corporate accountant, this 129, all those things are coming in chapter, schedule is coming in chapter 9. Chapter 9 precedes chapter 10. Chapter 9 deals with accounts of companies. And for every chapter there are allied rules. Companies accounts rules, 2014. Companies audit and auditors rules, 2014. Companies NFRA rules, here I don't remember. Companies CSR rules. So the Companies Act 2013, they say is a much smaller act with only 470 sections, but you have 3 hands to manage the rules and then the interpretations, all those things. But then still it is, the reference is possible, it has to be read together with all the applicable rules. So Schedule 3 last year, huge change, I mean the sweeping changes came in Schedule 3. And why are statutory practicing auditors sitting here? It is a job of, technically speaking, it is a job of the corporate accountant. But we have to help them, we probably sometimes we do it ourselves for them. So therefore that has to be very, very clearly understood and applied. CARO 2020, the auditor's report requirements have been made, very onerous responsibility, very difficult responsibility, including predicting the future of the company at least for 1 year. Till 2020 CARO came, the auditor was required to have hindsight, what happened in the past, what happened in the present. So we call it Bhutakalam and Vartamanakalam. Now Bhavikalam is also there. You have to predict the future. There's a clause. So somebody in lighter vein was saying, anyway you are changing the syllabus for CA final. Why don't you include a 20 marks paper for astrology also? So we have to predict in the future. We'll see when the right clause comes in CARO 2020. Then mandatory nature, we have discussed 143.9 actually. And this year the only change is audit trail. But can someone tell me what's the reporting and audit trail? Audit trail has been referred, right? But unfortunately, only the accounts rules have been changed, referred to 1.4.23. The corresponding audit rules, we'll see the section 11G of that rule has not been changed. Therefore, the auditor has a reporting requirement. Unfortunately, MCA could have brought out one notification and finished it, but they didn't. So there's a reporting, and we'll see towards the end of the presentation. So this is what is actually new. And now with that, with that we'll move on to Schedule 3 to start with, the changes which happen, major changes. Rounding off has been made mandatory. Earlier it said may, now says it shall be rounded off to the nearest hundreds, etc. So what did we do last year? There was a figure 1,97,328. I'm giving you an example. 197,328. How did we round it off to hundreds? 197,328. It should be ideally 1973 only, rounded off to 100. But Infosys is the annual report. I found that they are using decimals, 0.28. But that is, according to me, that's not rounding off. Not required at all. So if it's into thousands, it will become 197, round off to 1000. I'm just giving a simple example to drive home the point. The term tangible assets have been replaced by international terms. They are using all international terms, as if everything internationally is better than what's happening in India. The biggest corporate frauds and irregularities are happening in the US. And we are learning from that. Good things, bad things. Property, plant and equipment is a new term in place of tangible assets. It's all from Schedule 3. Schedule 3 amendment. In the shareholding details, under share capital, we have to give the details of promoter shareholding. Promoter, I think, is defined under 2 subsection 14. Section 2 is a definition section. 2 subsection 47, I'm not too sure, just check, somewhere near that. The promoter need not mean that who actually promoted the company. They continue to be the directors of the company, yes they are. But promoters would have sold the company, or they would have entrusted the company to somebody operational controls. They will also be coming to the definition of promoters. So all the promoters' holdings will have to be disclosed separately. What is the other disclosure prior to that in the share capital? 5% holding, 5% threshold we have to disclose. This has to be. Am I going fast? Is it going okay? Aging and date of completion. Now, this is something which needs to be discussed. Aging and the date of completion of capital work in progress as well as the intangibles under development. The capital work in progress, you would see in some balance sheets, the capital work in progress will remain without any change for 3-4 years, which means that most of the cases it is stuck. It's a project which cannot be proceeded with. It's actually a shelved project, but they're not draining it up, they're not writing it up, they're still calling it an asset. For example, again, I'm speaking state specific. Kerala, we have a lot of these issues on ecologically fragile zone. So those who come to Munnar or Idiki or Wayanad, you know that the hill stations, therefore they would say that you start getting initial permission, started doing a resort project in a hill station. But subsequently it is felt that it is a very ecologically fragile area, a lot of animals are there. Like I hope you know the story of Ari Komban, who has been exported to Tamil Nadu, spending crores and crores of rupees. And the reason for that is they went and did a settlement of people in a place called Anattari. Yane, Tamil Yane. Anattari. Anattari is the elephants, the route they take for their normal, and they started attacking people. And one of this guy was very, very violent and aggressive, called Ari Komban, and he used to go and eat rice from all the ration shops. He used to like rice, raw rice. That's the story. So then there's a stop memo. Then you're not able to proceed with it. There could be a political issue also. So what do you do? What's the point in carrying it as an asset? You have to discard it. Therefore, if it's outstanding for a longer time, the regulator wants information and also saying that discontinued projects we have to give separately. And if that is there for 2-3 years, ideally what should be done? It should be written off. It cannot be capitalized. Okay, it doesn't bring any value. The amount which you have invested there is a sunk cost, the costing term if you use, and therefore they have to be written off. So write-off is not mentioned here, but the aging has to be given. And expected date of completion also. What is that you're doing? Is there a board resolution? Is the board looking at seriously? Someone is stuck. Same is the case with intangibles under development. How many of you work with the startups? Kerala, we have a very, I would say, very dynamic, robust startup ecosystem. And of course, Chennai should also have, Bangalore has more, Hyderabad is more, and ours is the third largest ecosystem in the world. We have on the ministry, we have maybe to across 1 lakh by now. 2 weeks back it was 99,000 something registered startups with the DPIIT. Startup advisor is a good area and to specialize on. Initially there may not be much of money in that, but then you advise them, you mentor them, and then finally if you are able to get some funding for a working project, then it's a different story altogether. I've moved into that area and we do a lot of registrations of startups with the ministry. And when you say startup, you tend to think that there has to be a laptop, there should be techies. It's not really clear. Any innovation, the ministry would give you a registration as a startup. We got a garden company registered as a startup. When you go to the 5-star hotel, Starja, all those things, at reception, you will see the ornamental gingers. And now they're gifting it as, pots, pot plants, all those things. They're doing innovative this thing, and therefore we got it registered. And startups, quickly though I'm not a tax person, let me tell you there are 3 major exemptions for startups. The sunset clause has been extended to 31st March 24, which means that if you're registered as a startup up to 31/3/24, you get 80 IAC. This is a deduction 100% profits in a block of 3 years, in a consecutive 3 years in a block of first 10 years. 100% tax deduction. We are right of the old 80 sections, the 80 HSC, all those things, 100% deduction. 80 IAB, 80B, 80 IAC. The second one is the exemption on 17(2) perquisite. If a startup registered startup issues certificate shares or ESOPs, it is not taxed as perquisite under 17(2) in the hands of the recipient. Otherwise, it is taxed in the year in which it is granted. The options are granted. Now, this is granted only 4 years later. 4 years later, or if you sell it earlier, that's the time it is taxed. So 17(2) this and one more is there. The carry forward of losses. When more than 50% management changes, the shareholding changes, the loss cannot be carried forward. So 79. 79A. startups are exempted from that. The new investors, if some major chunk, they can carry forward that disallowance, or rather, the block of non-carry forward is not there. So the three important things which one must be aware of, that is not straying from the point, is very important. So what happens is this startup, they start working on apps or some product or a concept, they call it app development. So 3-4 engineers come together, fresh engineers, some will come together, we are developing an app. And app development happens, so they start now, for example, in August 23. March 24, when we are finalizing the audit, they would have spent, let's say, 20-25 lakhs on salaries, traveling, all those things. What do we do with this? Do we expense it? The kids tell us that, sir, we are still developing the product, we are moving on developing, so it may take some more time. And though it is slightly against the principle of AS 26 intangible assets, they are allowed to capitalize it because they are anticipating, the work is just in the early stages, anticipating that in 24-25, another 5-6 months of work together, an app would evolve, whereby we are all using apps today, which was, think about Tally many years back. It's not an app, it's a national accounting software. The guys would have been working in a single room. Today it is blossoming. And our Soho, the company last year posted a profit of 3,500 crores. So has been supporting all our programs. Since I was chairman and also been organizing many programs of the institute. At various levels, they have been supporting and popularize the product with the chartered accountants, and so has made a profit. With all these, we give that thing, but then how many years will they say that, sir, wait, 23, 24, 24, 25. At some point of time, a full stop has to be put and saying that, no, this is not going to come up. And then at that point of time, the entire expenditure will have to be written off. It is for that they ask us to show these details. Current maturities of long-term borrowings are now shown under short-term borrowings. This is actually a very, very misleading amendment, I would say, personally and professionally against this. Borrowing is essentially long-term. If there are current maturities, you should ideally be under current liabilities only, not under short-term borrowings. What are these current maturities? As on 31st March 23, 3 installments have already fallen due but not paid. Of the 12 installments, 12 EMIs, 3 are pending payment. 23, 24, another 12 are due. The current maturities will be 15 months of EMI will be your current maturities. That has to be shown. Now they say it has been shown under short-term borrowings. Aging of trade payables, MSME separately. Trade payables, not receivables. So what columnar form? Less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. Whose job is this? So I asked wherever, I would have addressed last year and this year put together, I would have probably addressed close to 50, 60 forums. All the chartered accountants asked it. Is there a single chartered accountant who sent a mail or a WhatsApp to the clients saying that Schedule 3 has been amended and the additional financial reporting requirement. So please instruct your accountant to give this thing ready. And today most of the software will probably take care of. Have you done that? We haven't. How far much done that is a different story. Whenever an amendment takes place, we think that it's our headache. When we work late into the night, we develop health problems, stress. The client is happy, client is in presidency club, don't worry. This has to stop. This is something which I have been trying to tell the members. Why should we worry? Tomorrow there is an appeal. You have a sleepless night. Your partner asks why you are not sleeping. Tomorrow XYZ Limited IT appeal is coming up. Huge demand, quick stay. Client is not bothered. Client will say that auditor will take care of. I am not advising a lot of senior members, but it's high time that the work culture of CF firms change. And no client will run away if you do that. And we are taken for granted. Anything that happens, a notice comes, it is forwarded to you. Not even read by them. That has to change, and we should essentially charge. 197 application for lower deduction of tax. If the amount is foreign companies, yesterday I was working on an application, of course with my partner. I was guiding him in the sense that the computation we cross-checked. Where we found that the saving is running into 2.8 crores. 2.8 crores. International taxation, now it is a physical online application, but physically we are able to appear in Cochin, and we have some familiarity, and we are sure of getting instead of 23.92% for a foreign company, for a non-resident, it is 20 plus 15% surcharge plus 4% cess. It works out to 23.92%. We are hopeful of getting a 2%. So the saving is about 2.7 crores. And how much do we charge? We still think that it is only work is very little. No? We charge only 5,000 to 10,000. That has to change. Our system has not to be discussed, but then that is the way we should look at it. That's always a bargain from the client side. And the client will talk about quality only when you ask for the payment, have you noticed? All the troubles will come when you ask for the payment. Sir, that fees is due, why don't you pay that? No, you delayed it a lot. And you send only junior assistants. Every week we are sending different assistants. That all he is keeping track of. Only when you ask for the payment. I'm not anti-client. Thank God we have a good number of corporate clients. But then there are sometimes we sign off. That's also very important. I'm not saying for that. Trade receivables and disputed and undisputed separately, less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. What is this tabulation for? If it's more than 3 years, will it not raise the eyebrows and say that, boss, what's happening? We have an acknowledgement of debt. Should we not make a write-off, at least a provision? Then provision, when they say, most of them no. So provision will not get tax deduction. So what is the point? Reducing my profit and not getting a tax deduction. So very rarely that we get intellectual interaction during audit filing decision, because the other side is always weak, most of the time. So these are all disclosure is still in Schedule 3. We have not started audit. What's the topic? Company Audit 22-23, all you need to know. The audit is still waiting. The corporate accountant is preparing the financial statement. I hope you get what I'm trying to say. Details of immovable property is not held in the name of the company. What is not held in the name of the company can find a place in the balance sheet. Very, very rare situation. The earlier company side, there was something called Chapter 9 conversion, where a partnership firm would be converted into a private limited company. I have done 2 cases in Kerala. Long back. It's under the 56 Act regime. Other than that, it has to be in the name of the company. Conveyancing has to be done. Then the tax has to be paid. The village records have to be changed. We call it Tandapere in Malayalam. Village records have to be changed and tax has to be paid in the name of the company. Only then the ownership is established. Who is checking all this? But then this is very important, and immovable properties, if not held in the name of the company, the details have to be given. Caro 2022 also that's a requirement. Similar requirement is there. When that was first introduced, I thought this is weird. It should be there. How can it be there? But then subsequently we were appointed for investigation by the official liquidator, High Court of Kerala, into a company which did something like a Ponzi scheme and went bust. And we found that 18 of the high value properties in the balance sheet was not in the name of the company. It was either in the name of the managing director or his wife. Even for address purpose, the company's name was not mentioned. It was audited, auditor's report was issued. So that is something the regulator has found in saying that audit company, you say, as a Schedule 3, audit also you make a mention of audit. When the revaluations of property done today, we have 247 registered valuer, it has been done by a qualified valuer. And if change in revaluation is more than 10% of the net carrying value, it has to be separately disclosed. Where do we disclose all this? All these 3 can be essentially under which schedule or schedule or which not. We don't call it schedules now. Property, plant and equipment. But what's the term we still use in our office? FA schedule, right? Are you using that? In our firm still, that is hangover is still not over. FA is fixed as a schedule. This is a PPE schedule now, property, plant and equipment. New students would have started only that. But we had to unlearn and relearn. But we are not unlearned enough. Utilization of borrowings, term loans taken, whether they have been applied for the purposes for which they have been. You have to go to the extent of seeing the sanction letter, where they will give the complete purpose, loan application. But the quarterly returns of current assets filed with the banks are an agreement with the books of accounts. This has to be given by whom? This is Sri Kumar is a banker. So I'll tell you something. Entire Schedule 3 amendment and CARO 2020, if you see, has been made for a banker, for the bankers. It is from banker's perspective. And one of the persons who was spearheaded, or rather led this amendment, is Sri Amarjit Chopra, past president of our institute, with whom I had the good privilege of working 1 year, 2005-06, when I was member of the Auditing and Assurance Standards. When Manohan sir became vice president, he co-opted me to AISU in 2005. Chopraji was the chairman and he later became president. He is now the spokesman of the institute, mouthpiece, or rather a person, whenever there's a business line, when you read, you hear, other than the president, Chopraji being quoted. All this because the banks today have a huge problem. We talk about the India growth story, all that, but then there is a lot of rot in the banking system. The real NPA situation is much worse than what is seen on the paper. And that is precisely why Ind AS has not been made applicable for banks. They are still under accounting standards, right? Ind AS have been made applicable for NBFCs, but not for banks. I asked a senior banker, a chairman of one of the Kerala banks, managing that, not chairman. I said, sir, why is it being done? Joman, you should be knowing better. It is an orchestrated delay. If you apply all your Ind AS principles on bank balance sheets, they will tilt. There will be a lot of problems. And that will create an issue globally because the banking system, there will be a lot of new exposures, write-offs, mark to market, fair value, all those things that can be problems. So that is how it is. So now all these things are from a banker's perspective. It looks like a bank manager has drafted the old amendments, the majority of them. Quarterly returns filed of current assets filed with the banks. CARO also there's a reporting requirement, but CARO luckily this requirement is only if there is a borrowing, working capital borrowing exceeding 5 crores during the year. But here, every small company has to report whether they are in agreement with the books of account. Now, what are these quarterly returns of current assets? Will have trade receivables, inventories. So we are supposed to check June 30th return, September 30th return, December 31st return, March 31st return. Yeah, that is surprising. That's surprising. Actually, it should be net current assets or whatever. So I'll come to that. But how people do, or probably with your permission, Sri Kumar, what the bankers would do them, don't put us in trouble. Give a statement where the DP is intact. So my limit is 1 crore and my DP is also 1 crore. So I start putting 1 crore at some place and say that current assets, current liabilities worked out, and 75% of that should be 1 crore. This is a back working that many of them do. To check that is only this clause has come. Ideally, those who are dealing in banks in loan syndication, the Indian scenario, commercial banks lend 75% of the net working capital. 25% is what is known as the contribution of promoter's margin. So ideally, sir, what you said is right. You should have in current assets and current liabilities. Inventories, receivables, worthy loans and advances, and of course less current liabilities. That's not asked, current assets. At least this they have asked. But the problem I'm coming to that, madam is smiling. Receivables, of course, we take a trial balance listing. That is June, all these 4 quarters. Stock, where do you get it? Where is the stock register? And stock register, if you take a printout of the so-called stock register, which is the tally inventory module, most of the time you will see negative stocks. All are laughing, so it is a real situation. Only difference is that I am standing here, you are sitting there, and I have a pot. It's a very, very challenging requirement. And we are still scared to say it is not active, they are not agreeing. That is in CARO. But here this has to be given. So inventory is very, very difficult. So how we do it? It has to be done properly, that's all I would say. Whether the company has been declared a willful defaulter. The guidance note from Schedule 3 talks about willful defaulter. They are referring to the RBI Master Circular. I am saying there was a willful defaulter. According to me, a willful defaulter is one who has the resources but is very adamant that I will not pay. I am quoting again Manoharan sir. He said, somebody said, It is against my principle to pay interest. And it is against my interest to pay the principal. Matters over. Whether registration satisfaction of charges have been done on time. Those who have done bank audits, corporate clients, we would say, in earlier days, 125. CHG 1 for registration of charges, CHG 4 for satisfaction, whether they have been done on time, etc. etc. Now, I think in CHG 1 in new regime, if it exceeds more than 60 days, it cannot be done. It cannot be done. I think you have to go to the RD and get it done. RD is, for you, it's so nearby, RD is here. For us, we have to travel from Cochin to come and meet the RD. And then NCLAT also, we have it here. In CLG, we have a bench in Cochin. Appellate tribunal is in Chennai. So these are the requirements there. And then details of loans and advances to related parties. This is in addition to the reporting requirements under ASIG accounting standard. So all these will have to be fully disclosed. And I'm only happy to share the slide deck at SIRC or to those who have attended this program. Towards the end of the presentation, I'll share my mail ID. I have no problem. Some homework has been done, but I don't attach too much of APR into this intellectual property right. Wherever possible, I try to share. I hope you would have received a mail from me on the audit kit. I sent an audit kit to the whole of South. Some of you would have received it. Contains most of the documents which are required, including an editable Excel format of Schedule 3 and an editable format of Carol 2020 report in Word, MS Word. If you have not received, I'm only happy to share that. Now, this is one thing. Whether proceedings have been initiated against the company under the Benami Transactions Act. One has to, the company has to give all the details. So again, going through the board minutes book. And somebody said, sir, there are no cases, we are clean. Then the senior told the junior assistant, just take a printout of legal and professional charges. Seniors would say legal and professional charges, print out. For the new gen printout, printout is not required. So in my office, I ask the students sometimes, since I'm spending more time at the office after my SIRC chairmanship. And so I ask the student, come let's discuss and finally show me the LS notes. We call it ledger scrutiny. So earlier, what is the situation? There was a thick box file which had all this. Today the student comes with the laptop and says that, sir, it's in the folder, LS notes. You pull out this thing and put your comment on it. Yeah, that's perfect. Provided you have the backups. And gone are the days of thick old box files. And filing has always been a problem. In lighter vein, it was said that 40% of the time in CS offices are lost searching for files. And if you fortunately locate the file, another 40% of the time is lost in searching for the right paper. Yeah. So that's where the old standard of documentation said, please have a permanent file and a current file separately. Permanent file and current file. In Burma Dorma, where we did the article, we used to call it main file and working notes file. These are all good practices which can still continue to the extent we retain hard copies. Now, internal auditor's report, today there's an important requirement. Are we keeping all the 4-quarter reports or the hard copies? You don't have to. Just get the scan copies and read in the folder, higher reports. Coming to that when we discuss this later. Whether company has acted as an intermediary in a money laundering transaction. So this PMLA has become a big concern. Chartered accounts have been brought into the ambit of PMLA. Initially lawyers were not, so we were worried. But then they made lawyers also under PMLA. There was a huge heated discussion at the Ernakulam branch where I was asked to speak. I said I don't see a problem as long as we do not yield to the client and work with them on these kind of transactions. And I quoted certain firms where I said that why are we not seeing a partner from those offices? Because they don't get into. Today, majority of the time, and it was triggered by, I don't know whether you know, Mohan R. Levy had written an article in Business Line, where it was triggered by chartered accountants in Mumbai helping the banned Chinese app companies to do operation. They were lending names, they were giving their houses, addresses, crores of money coming to their accounts in their wife's name, in their cousin's name. So were lawyers. And finally, why not? What is the insulation we have when we get into untoward transactions helping the client? So that's how PMLA came in. But here, we're not talking about, we're talking only about whether the company has acted as an intermediary in a money laundering transaction. The same reporting requirement is there in CARO 2020 also. I'll give you an example. A company, our client is a private limited company in Chennai. There's a straight transaction of a crore getting transferred from a Sri Lankan company. Company in Sri Lanka has transferred some money to this company, 1 crore INR. With an instruction that remit 90 lakhs to a company in UAE, 10 lakhs is yours. It's a one-time transaction. There's something in it, right? You should raise a question. There should be a query. Students should know. They should raise a query. So therefore, this is a requirement. Again, they have to report under Schedule 3. Details of transactions struck off companies. Companies have been struck off, but you still have transactions. It can happen that they manage to strike off the company, but still keep a bank account open. They take out funds transaction. But how do we determine? Are we supposed to go through every transaction as a struck off company? Irregular transactions, no purchase, sales, fund transfer, etc. If you smell the rat, you can go to the MCA website, give the name of the company, identify the SIN and find out whether it's an active company or a status active or not. You should do that. 287 whether have been complied with. 287 says that in a vertical holding company, subsidiary company chain, there can only be 3 layers. A company, subsidiary B company, subsidiary C company, not more than that. D is not possible. Horizontally you can have. A company can have B, C, D like that. Vertically, that's all. But if B company is a 100% subsidiary, then they can go for one more layer. A company, 100% subsidiary B, subsidiary C, subsidiary C. So whether 287, the requirement of layers have been complied with. Full details of CSR expenses spent and spent. See, 135 CSR, what started as a very, very friendly section. The pat on the back, you're making profits, please give 2% for social costs. Today it has become a pain. Because a company with 5 crores, 3 criteria, 100,000 crores of turnover, 500 crores of net worth, 5 crores of profit. Many of our clients will have 5 crores. And the section says, exceeds 5 crores in the immediately preceding financial year. So when you're doing 22-23 audit, you have to see whether 21-22 PBT exceeded 5 crores. Then it is triggered and it should become applicable from the financial year 22-23 for the year which we are auditing. Is it clear, sir? Previous day says as by immediately preceding financial year. So 21-22 if it has exceeded 5 crores, the profit is PBT and not PAT. Then 22-23 financial year, the provisions of 135 have to be complied. Valid rules. CSR committee has to be formed, but then later gave a clarification that if your spend is less than 25 lakhs, CSR committee is not required, board can go, etc., etc. And what is not spent should be transferred, 135.5 and 135.6. But then, complaint very poor, the company has to give all the details. Similar reporting requirement on CSR under CARO also. We'll see that when we reach that point. Details of crypto transactions, if any, whether the company is entered into crypto transactions. The new term is VDA, virtual digital assets. And last budget, Madam decided to tax them at 30%. So the other day somebody asked, they are just dealing only in crypto capital, they haven't made any profit, they are just invested in crypto. Then I said that also has to be reported. Doesn't say profit or surplus. Any crypto transactions have to be reported. Again, where? It's all about Schedule 3 in the financial statements, not in the auditor's report. Lastly, we have the financial ratio. This is a very meaningful thing according to me. Health analysis, analytical procedure is easy. If the variation from previous is more than 25%, then it has to be explained. Variation has to be explained. Current ratio, etc., etc. Return on investment, if you look at that guidance note. And where do we look out for guidance? For everything there's a guidance note. Guidance note on revised to Schedule 3. Division 2, Division 3, NBFCs. Separately. Most of our clients will be in Division 2, which is non-Ind AS company. Guidance note is very, very exhaustive. But if you look at that particular return on investment, the other day when we were discussing in Cochin, a member came up and said, sir, it will apply only if this company has investment in other company. No, it's not that. It is only about the in-house company thing. So finally, if you look at all the formula, my interpretation is that return on investment would mean PAT divided by share capital plus reserves. A lot of sigma R1, R2, you see the head will spin if you look at the formula given in guidance. Young members and students should refer more. At least download and refer more. You don't have to take a printout. But in our office, we still buy, through the CDS, we buy all this guidance note on Schedule 3. Guidance note on CARO 2020 is also there. But let me tell you, if I forget, why we are at that point, if I forget, CARO 2020, the original, the first edition of guidance note came out in 2020 itself, which is completely made in haste and it is misleading. Now they have revised it in 2022. That's the only reference we should do. CARO, guidance note on CARO 2020, edition 2022. Hard copy or soft copy, whatever you are referring to. In the P&L, they have said revenue has been replaced with the total income. So according to me, again, revenue and income has a different connotation altogether, so that should not be mixed up, but that's the case. A new line item has been introduced as grants and donations received for the sake of Section 8 companies, non-profit companies. To give details of unrecorded transactions surrendered disclosed in IT assessments. This is something which, this is what the company has to give. Details of unrecorded transactions surrendered. What is the requirement in CARO? The corresponding requirement in CARO? Whether the unrecorded transactions have been recorded by the company. If it is not recorded, the audit has to. Here they have to give only the details. They are not saying that it has to be accounted for. I was trying to give this example. I am not a tax person. An income tax search has happened. In layman's terms, a raid has happened. Everything is okay. Finally, they were about to leave. They pulled out one table, opened the table, and found that there is a title deed of a landed property, 2 crores. 2 crores. Not anywhere in the books, anywhere. That's the only thing they did check. Everything else is okay. Explain. This is not explained. Where does money come from? Accumulated unrecorded income they were given, right? How do we account for it? Should we not account for it? We should. Otherwise, true and fair is certificate is 2 crores. How do we account for it? The block assessment is not there now, right? So what's the tax rate if it is unexplained in section 68? What's the tax rate? I'm assuming it's 60%. Anybody can help me? 80, 60. The normal rate, it's not the normal rate. Assuming 60%. What's the accounting entry we have to pass? I would put it this way, land account debtor 2 crores. To provision for taxation, 1.2 crores. To revenue reserves, 0.8 crores or 80 lakhs. Do you agree? According to me, as we have debated in many forums, when we found that okay, this has to be account revenue reserve or to P&L account. Ultimately, it's a revenue of the same. Now, this entry has to be passed. A provision for taxation is made. So just for understanding, so here they have to give. This brings us to the this is the last slide in Schedule 3. Students, how do you know? How do I know that it's the last slide? Not here. It's here. That's the sort of thing. I have on the topmost you can see light blue. I put last schedule 3. It's not magic. It is some good preparation. Very important for your final exam. That brings us to CARO 2020. Can we go on? Only 6. What time did we start? 5. Supposed to be 4:30, but we start at 5. That's called IST. It's not Indian Standard Time. I came flying Indigo, so they said Indigo Standard Time. But IST for ICAI is Institute's Stretchable Time. On a working day, members will never happen at 4:30 because they go to office and round up everything and come. Morning programs where they say, sir, I'll just peep into office and come. If you go to office, you'll have to come out before 11 o'clock. And after COVID, you started feeling that yes, it is better that I get this in my drawing room or my office room. Why come driving all the way from, Kilpok or wherever to Nugambagam? But it's high time that we started getting together, physical numbers. Then COVID started and companies like Twitter said, this is good, people are working from home and there's a lot of reduction in cost. Productivity is more, it seems. Are humans machines? It was Satya Nadella who said categorically, you know Satya Nadella, right? We are proud that Indian born chartered accountant has been made the CFO of Tesla yesterday. What's his name? Politics. So Satya Nadella said working from home cannot be a permanent feature. Essentially, after the epidemic is over, contained, we have to go back to our offices. We cannot burn the social capital we built over the years. Office gossip, office romance, all that has to be back. And the Kerala head of TCS was 18,000 people under him. Dinesh is a good friend of mine. So he said Saip was foreigners, we call it Saip. Tell me what you say. So Cyprus started asking, go out and meet people because deals will happen only in corridors, not always online. So I think the scare has to go and then people should get together, large numbers, come have the coffee, tea. I hope it's okay. Yeah. I was chairman 1920, I used to come more frequently. Every Saturday, Friday, Saturday I used to be in Chennai. I just went for the sake of it to see the chairman's room, but it was locked. Not to sit there. I would just sit in a higher, position. That's different. And nobody can apply brakes on your dreams. Only your internal limitations or internal restrictions can limit your dreams. So Caro 2020, I gave you the history. It was originally notified in February 2020, finally made applicable only for financial year 21-22. Students, it's easy to remember. 21 clauses, 777. 7 new clauses, including 2 re-introduced. 7 clauses modified. 7 clauses retained as it is. But like the Companies Act 2013, you have 47 subclauses. Under inventories, everything you have subclauses. We'll discuss the new clauses first. I think for the sake of time, we are going to discuss this in detail. Transactions not recorded in the books, which we have seen already. The ability of company to meet its liabilities. Astrology. CSR, transfer of unspent amount to the funds under Schedule 7. Statutory audit resignation. Consolidated financial statements or reference to negative remarks in subsidiary CARO. Is CARO applicable to consolidated financial statements? It is not, but for this purpose, in the main body of the report, you have to add a clause. That clarification has come. Internal audit system, reintroduced from CARO 2003. Cash loss, again from CARO 2003. Modifications are there. Now we will go one by one on. Okay, we look at the applicability also. First April 21-22 is over. Every company, including a foreign company, government company, branches, not applicable to banks, insurance companies, Section 8 companies, one-person company, and small company defined under Section 285 of the Companies Act 2013. There's one more clause with borrowing of 1 crore, etc. There's a lot of discussion on this. The Institute's guidance order is clarified. And also, the general consensus today is that if you are a small company, you are exempted, you don't have to ask any further questions. 285 is the definition section. So what's the definition of a small company for the financial year 22-23? What are the monetary limits? It is 4 crores and 40 crores. And the joinder is and. When originally 285 is enacted, it said a small company means a private limited company whose paid up capital does not exceed 50 lakhs or its turnover does not exceed 2 crores. Don't write it down, this is all past. Subsequently, they realize that or is not enough. The joint has been changed from or to and. It means that to be a small company, both the conditions should be cumulatively satisfied. For this financial year, neither the paid up capital should exceed 4 crores, nor the turnover 40 crores. That is the implication of and the new limit is 4 crores and 40 crores. $40 crores as per the latest audited financial statements. Internal audit system, new clause reintroduced in 2003. Whether the company has an internal audit system commensurate with the size and nature of its business. For what's new? Whether the reports of internal auditors for the period under audit were considered by the statutory. There's a standard SF 610 if I remember correctly, using the work of an internal auditor. Standards auditing system. So here, what is the situation? You would ask, do you have an internal audit? Yes, sir, we have an internal audit. Who is internal auditor? All of them are doing it. All the entire department. Do you have a report? Report is not there, sir. We're discussing every point and finishing of that. This will not sell anymore because of the second clause. It says whether the report of the internal auditor has been considered by the statutory auditor. So at least for namesake, there has to be a report. We should be part of the statutory auditor documentation. And two of the state government, state PSC audits we have done. One we have finished 21-22 where we issued this adverse report, and one we are doing now of 22-23. Internal audit is just a farce. It's just a farce. 3 quarters report they have given together. It's only a 2-pager. Turnover of the company is 160 crores. So simply say that we have seen the report of the audit, but look at that. Commensurate the size and nature of the business. We qualify. And now this audit we are going to do kind of finalizing in another 10 days. Last quarter internal audit report is not yet ready. So there's a tug of war in office between the internal auditors and the statutory auditors. Finally there's an agreement. Morning lecture for the internal auditor, afternoon for the statutory auditor. You know, that kind of things. I remember doing an audit in Bangalore long back. So my boss came to the internal auditor, he was dragging him. Finally he said, Mr. Ramchandra, I hope you will be able to complete the internal audit at least before we complete the statutory audit. That situation was with the places, but again according to me, this should not have been made applicable for all companies. Section 138 talks about internal audit, where there are limits, 10 crores, 20 crores limit, I am not able to recall. Ideally, this clause should have been only made applicable for those companies for whom internal audit is mandatory under 138. Even for a small company, we have to report.
But 200 crores they have mentioned. As per law, it's 200 crore limit is there.
No, that's under 138, but under CARO they have not mentioned. 138 limit I am not too sure, but on CARO no limit.
So my question is, normally the company is not required to have internal audit system if the turnover is less than 200 crore.
Where is it said, sir?
Only 200 crore, if it exceeds 200 crore, there should be an internal audit.
Not to my knowledge, because 138 is section on internal audit, where they have given certain parameters. I can, if somebody can Google up and that is one of the rules you have to see. The students may be able to do it fast. 138 rules, if you see, the limits are mentioned. 200 crores, that's nothing else. Maybe in one of the criteria they would have given 200 crores. There are multiple criteria on paid up capital, etc. We'll just check. But this is a reporting that came in. Whether there is an internal audit commensurate with the size and nature of the business, whether the statute audit has referred the internal audit reports. So if I move there, I will still be out of frame, is it? He's repositioned the camera. Sometimes I keep moving, I should be okay. The audio may be there. Can we move on? Cash loss, again brought back from 2003. Whether the company has incurred cash losses in the financial year and the immediately preceding financial year, if so, state the amount of cash loss. Cash loss, you know that is depreciation has to be taken out. New clause 3. Whether the transactions not recorded books of accounts have been surrendered, disclosed as income. Whether previously unrecorded transactions, this is the new thing under what is given in a separate color. No, yeah. Whether the previously unrecorded income has been properly recorded in the books of accounts. So statutory auditors report. But in Schedule 3, it was giving full details of it. They would insist on the accounting part of it. You have the answer? No. Okay, fine. Leave it. But if you ask, jail release aja, 200 crores, only one limit. Is there differentiation? Public limited company, private limited company? You just note down and then we'll discuss. So I thought you were taking that. Jailer is released already? Tomorrow. Nale. Okay, if I ask them what is the collection, gross collection of jailer as of now, you'll get it faster. So, clause number 3 is this. Slightly different buttons it is. Yeah. Whether previously unrecorded income has been properly recorded. Moving on. Whether the statutory auditor has resigned during the year and you are appointed in place of the resigned auditor. Whether you have taken into account all the concerns, issues raised by the outgoing auditor. Now, when an auditor resigns, what happens? I have to spend some time here. The incoming auditor who is appointed has to communicate with the previous auditor, where we ask whether you have any objection in now taking up the assignment. To that letter, you should also add a new paragraph saying that. Also, let us know whether there are any major issues, concerns, which should affect us as auditors of the company. We may or may not answer, but that much we have to do. And then if it's not saying anything, yes, it has been addressed, has been inquired on the issues and concerns. Now, one more thing is the large number of disciplinary issues are happening because the auditors, the incoming auditors do not communicate with the previous auditors. And can an auditor be removed? What is the term of the auditor under the Companies Act 2013? What's the term of appointment? It's 5 years, not 1 year. So if your auditor is appointed as auditor for a period of 5 years, you cannot be removed within that 5 years except with the previous permission of the central government. Many people do not know that. They think that it's like having idli one morning and dosha the next day. I don't like idli anymore, so I want dosha. And day 3 is uttapam. And when auditor resigns, please know that the board cannot. Board has to fill it, but then it has to be finally ratified by the company in general meeting. Only then the appointment will take place in the case of resignation. All other casual vacancies other than resignation can be filled by the board, who will hold office only till the next AGM. So that one has to be very clear. Don't take up audits immediately as you say that, sir, that fellow is not good, you are very good. You are fabulous. Also, those are the terms the new gen uses. Okay. Now we have to discuss with the auditor and also get this included in the management representation letter. And coming to that, very, very important, SA 580 written representations. How many of us obtain written representation from the management as we conclude an audit? They're mandatory, not by the institute, under the Companies Act 2013. Capability of meeting its liability. Look at this. This is the astrology clause. On the basis of financial ratios, the aging and expected date of realization of financial assets and payment of financial liabilities, other information accompanying financial statements, the auditor's knowledge of the board of directors and management plans, whether the auditor is of the opinion that non-material uncertainty exists as on the date of the auditor's report that the company is capable of meeting its liabilities existing at the balance sheet date as and when they fall due within a period of 1 year from the balance sheet date. The auditor is expected, asked to predict the 1 year continuity, business continuity of the entity. There was a huge problem when the pandemic was there. The SA 570 was a standard which was discussed most. Going concern. Whether this entity who's in tourism industry would be able to pull on and continue to be in existence. It's a huge question. But if going concern is at stake, if going concern is doubtful, then what happens is you will have to write down your assets substantially. The Ind AS, I don't remember the number, we have a standard AS 24, discontinuing operations. The corresponding Ind AS standard says discontinued operations and non-current assets held for sale. That makes it very clear. I repeat, discontinued operations and non-current assets held for sale, which means that your land, your building, your plant and machinery, your vehicles, all that is now for sale. And similarly, on a liability, you go to a bank, go to Sri Kumar and ask for an OTS, and you will be kind enough to grant you a 20% waiver. That means has to be returned back. Liability becomes less, and you will write it back into your P&L account, and so on the story goes. So that is all covered in here. So the auditor should see, because luckily we have the financial ratios, look at the management plans that we're discontinuing. And also SA 570 talks about situations where you doubt the going concern capability of an entity. Huge outstandings, statutory outstandings. Loan has become NPA, both your term loan and working capital loan has become an NPA. You have long outstanding statutory dues. The employer's salary is not paid. And business volumes have substantially come down. Receivables payments are not forthcoming. There are a lot of issues. So therefore, you will take again a call on whether that will be able to continue.
Sir, is it not too much to demand a such a report from us?
Absolutely, I agree.
So what's the objection we should raise this matter? Because we are giving the report on 5th of September, already 5 months gone. So when the vendors, when they take up the matter, mentioning, you have certified that way based on that I made the supply. Now the company has gone on rent. So you should take the responsibility of answering me. If the vendor raises the matter subsequently. So we are, so the, it should have been wrongly objected, we should have taken to court this particular clause. I don't agree with this certifying that way.
You are saying that the Institute Council reaction to this very demanding requirement has not been aggressive enough.
It's impractical and it is too much. And so we have just like the surrendered to the government.
To some extent, yes, I agree. But then the whole point is that, we asked, that's why I said, if indefinitely you're talking about this, this is an indicative thing, and even if this does not, if it's processed within 1 year itself, if we have the sufficient documentation and evidence to defend, you are not in trouble. What happens is, many of us, many of us do guesswork and saying that we blindly report on this, irrespective of this. I was in Belgaum about a month back, more than a month back. So one of the members, I'm not straying from the point, one of the members asked, Jovan, we already have that clean report in our system, no? Why should we change it to this qualified opinion and disclaimer opinion? He finds it very painful to change. He feels that every audit at every point of time, irrespective of the irregularity, is expected to give a clean report. That has to change essentially. I fully agree with your point that at this time, at least the corporate law committee could have taken it up strongly and saying that this is asking for too much. And therefore, probably the clause could have been softened a little bit.
Sure, because we talk about current asset more than 1 year, less than 1 year, less than 3 years, all this we are talking. Same way payable we are. So we have disclosed everything, they demanded to disclose everything. And this was the lender to think and supplier to think and control. Why we should certify, why we should agree to certify?
I agree, that's why I said it has become very demanding a clause where CARO 2020 is, in the introductory remarks I did mention that CARO 2020 has become a lot of onerous responsibilities where I said, I did mention hindsight and we Bhutam, Vartamanam and now Bhavi also, not like taking it like, it is difficult, but then now that it is part of the law, it is established that we have to comply, that's only. I share your concern. Now on all this, while SIRC point is very, very valid, for this to reduce the work to become defensible, we should really get written appreciations from the management on receivables, financial assets. Again, there's a 580 that I mentioned. Board's documentation of review of the liability position, like a banker does, includes specifically all that material events which are happening after the balance sheet date, etc., and so on, post balance sheet. A transfer of unspent CSR amounts to fund. This is very, very serious matter. Okay. So the CSR clause today that is become very demanding, where you have if CSR becomes applicable, the board would or the CSR committee would decide on projects which would sometimes go beyond 1 year. They are called ongoing projects. Like for the first time, 22-23 CSR become applicable, 22-23. So the board says that the amount to be spent is 5 crores. On this, we will spend 2 crores on a housing and a sanitation project in a remote village somewhere in Tamil Nadu or Kerala, which is going to take 2 years for completion. Okay, that is 3 crores. Out of the 5 crores, 3 crores. 2 crores they are saying that they are other than ongoing project, which means that they would spend it in 22-23 itself. Other than ongoing projects, if you fail to spend this 2 crores within 22-23, the unspent amount will have to be transferred within 6 months to a fund mentioned in Schedule 7. Schedule 7 is a schedule which gives you the list of eligible activities which are, to be made under CSR. It is gone. Within 6 months, you have to give it to any of the funds prescribed in Schedule 7. But if it's an ongoing project, what can happen is out of the 3 crores, are you with me on the figures? 5 crores is the total this thing. Of that 3 crores is for ongoing projects, this village adoption or housing project. Of the 3 crores, you have spent only 2 crores. The balance 1 crore has to be deposited within 1 month from the close of the financial year in a specified bank account. So April 30th, this should be deposited. Okay. And then spend only for the CSR purpose for which it's already due. In both cases, the statutory auditor has to report whether these provisions of 135, 5 and 6 have been complied with. But unfortunately, for not transferring the fund, MC has imposed penalty on small companies, not very huge companies. So CSR is a very demanding provision. Luckily, last time we finalized an audit about 2 weeks back. But just before it was this thing, I was under the impression that it was PAT. And there's some doubt which came up, and finally we referred that the profits of the previous year, 21-22 PBT had exceeded 5 crores. So then 22-23 CSR became applicable. So belatedly we advised them, not as part of the audit, advised them to form a CSR committee. Finally we found that's not required because the commitment is obligated less than 25 lakhs. The board to have a policy made, and since it does not spend, they have time till September 30th to transfer it to the missing, and a note was made, and the auditor's report also we made it clear. So the reporting requirement is whether 135.5 and 135.6 have been complied with. The last note we have already discussed. If in the consolidated financial statements, the holding company auditor, while issuing the consolidated financial statements, the main body of the report, if there are qualifications or adverse remarks by the auditors of any of the subsidiaries, it has to be highlighted included in this auditor's report of the consolidated financial statement. That brings us to the end of arrow or the new clauses. Moving on, there are certain things one has to be aware in the space of sphere of corporate audit. All companies except small, dormant and OPCs must prepare cash flow statements. 2 subsection 40 says the financial statements include balance sheet, P&L or income and expenditure account, cash flow statements and SOCE, statement of changes in equity. But subsequently they say SOCE is applicable only for India's companies. Cash flow, yes, but then small companies, dominant OPCs are exempted from the preparation of cash flow statements. But what happens is, even when cash flow statement is prepared, the auditor's report should immediately include that also. But if it's a copy paste from the previous year, sometimes we say that the balance sheet gives the position, the P&L gives the performance, and we're done with that. It should be included in the cash flow. So cash flow also should be included. 215 view of the cash flows for the year ended on that date. Depreciation, I think the new regime we have settled in. It is not any arbitrary rates like it used to be under Schedule 14. Under Schedule 2, it gives a useful life. Based on that, we will work out the rate. An arbitrary 5% has been fixed as residual value. But 5% can be different. It can be 10%. The useful life can be different from Schedule 2. How? They say it is possible, but based on technical evaluation and report. The auditor is not competent. Chartered account is not competent to say that my for computers how is a useful life? Three years. And if you give to the article clerk, 1 year. They do everything with that. Sometimes they play football with laptops. Now, it depends on the use. Lighter weight, take it lightly. A lot of students are very close to my heart. I was the chairman of the region. We have a lot of students in our office, so we interact with them. You know, some of them are very careless. And if the boss says something, they'll hit the laptop like this. As if they're hitting the boss. And I'm the senior partner, you're reminded. The parrot, $500. So this is very important. So technical evaluation, it can be different. I remember seeing the Infosys annual report where they said, based on technical evaluation, the management feels that the useful reason best represents the period for which asset can be effectively used. And sometimes the legal life can be less than the physical life. That's also there. If there are legal restrictions on use, etc., then the legal, whichever is shorter, has to be considered. Common accounting, we leave it. Intangible assets, AS 26 will apply. What is the cardinal principle of amortization in AS 26? It says there's a rebuttable presumption, can be rebuttable presumption that the useful life of an intangible will not exceed 10 years. But if it's computer software or website, web design course, etc., it is just 5 years. Rebuttable presumption is you should have the evidence to rebut this, break this 10-year barrier. Now we would have traveled on highways, particularly in Kerala, you have a lot of railway overbridges, where there's a toll collection. The toll rate is an intangible. The company, the infra company, which is a Kerala government company, construct this overbridge, and for the first 5 years they will give it on. They will auction and give the toll right to an agency. It could be XYZ and private limited. They acquire this right for a crore. So ideally, the crore should be written off in a period of 10 years. But I said 5 years, I stand corrected. The agreement says that you have a right to collect toll for 12 years by paying a premium of 1 crore. So since this is 12 crores under the agreement, you can break the 10-year barrier and amortize it over 12 years and not 10 years. That's a rebuttable presumption we're talking about in AS 26. Accounting standards. I was this afternoon in the hotel room, I changed this and put a question mark in red colors. All the accounting standards will apply. So how many accounting standards are there? It's actually 29 minus 2. They have not said 27, they have not been renumbered. There are 29 standards, AS 1 disclosure of accounting policies, AS 29 provisions, contingent liabilities and contingent assets. But in between, 2 standards have been withdrawn. AS 8 was withdrawn long back, reserves and all. In 2020, they withdrew AS 6. AS 6 is what? Depreciation. And they blended it into AS 10, which is property, plant and equipment. All the name was accounting for fixed assets. Now to see what depreciation is, how depreciation has to be charged on tangible assets, please refer paragraph 40 to 60 of AS 10. So 2 standards have been withdrawn, so in the result we have 29 minus 2 standards. Many of them are not generally applicable. For example, segment reporting is not applicable for small and medium companies. There again, I don't have the time. I think the reference point should be Companies Accounting Standards Rules 2021, which is superseded the old Companies Act, Companies Accounting Standards Rules 2006, made under the old Act. That was amended in 2020. Finally, now they have replaced it with Companies Accounting Standards Rules 2021, where they define what a small and medium company is and say that some of the standards they have partial and total exemption for small and medium companies. For paucity of time, I'm skipping that. That permits will come back and see. The IS 15 employee benefits, very casually seen. Please know that in the case of companies, actuarial valuation is mandatory, irrespective of size. Even if you have only 20 employees, actuarial valuation is mandatory. If a company is not doing it, the auditor has no option but to qualify his report. He will say that the compliant with all the accounting standards referred to in 133, except AS 15, as provision for gratuity is not made on the basis of actuarial valuation. AS 16, borrowing costs. Capitalizing borrowing. When do you capitalize borrowing costs? Interest. I'm a trader buying and selling potatoes. I have working capital loan from South Indian Bank, 2 crores at 10% interest. My 20 lakhs of interest is expensed. I'm only a trader buying and selling, and it's an ODCC. But now I feel that there is a new craze for potato wafers, chips, and potato wedges. Newton wants it, French fries. So I'm going to establish a plant in Maramalai Nagar. I know that industrial area. I've been there for stock verification. I'm doing article. 3 years already have all gone together. So Maramalai Nagar, I'm putting up a factory where I'm going to manufacture all these wedges, lace, the wafers, all those things. So I acquire land and start constructing a building. And again I go to Southern Bank and ask for a term loan of 2 crores, they sanction. And the building takes about 15 months to complete. Simultaneously, I'm installing all the machinery, and 15 months from the day they started, I'm able to invite Mudal Amaichar to inaugurate my factory. Okay. So this 15 months, what happens to the interest on term loan? What should be done? It should be capitalized. From the day you started till the day the commercial operation started. But what if it's 15 versus I'm smarter, like what China did during COVID time? They construct a hospital in less than 1 month. So I'm able to do this, instead of 15 months, I'm able to do this in 9 months. No, we cannot. Capitalization can be done only if there's a qualifying asset. A qualifying asset is one which takes a substantial period of time, which has subsequently been given in an ASI, accounting standard interpretation, as 12 months. So how much of construction you do, if you make it ready, unfortunately, in 9 months' time instead of 15 months' time, the entire expense will have to be, the entire interest will have to be expensed and not capitalized. Are you getting me clear? You have a point, you have a question. It's in AS16. And again the situation changes. Now I talked about only one term loan. Specific term loan for a building. I leave it plant and machinery. But I am borrowing 2 crores from bank at 10%. I have 8% debentures. I have loan from directors at 12%. So I have a mix of avail of sources and avail of applications also. We used to have ADA avail from income tax canteen when we were studying here. We used to bring lunch upstairs. So we used to have 6 rupees meal in the income tax canteen. They used to give a lot of more. We liked it. And also some days it was ADA avail. So avail of resources and avail of application, because this amount is spent for building, machinery, electrification and some consolidated plant. So I cannot allocate it to a single building. Therefore, again, there's a concept called capitalization rate, where you arrive at the weighted average cost of your borrowings and apply it on these assets based on the outlay of the individual. Slightly technical, but if it is there, you should not just expense it or capitalize blindly. The cardinal principle is, if your asset is taking more than 1 year, more than 12 months, again they say, for its intended use or sale. That's where the catch is. What do you mean by sale? It's an item of inventory. You're not constructing this thing. You're doing some products which will take more than 1 year for completion and delivery. Intended use or sale. Which means that the principle which is given in AS2, which says financial charges are not normally included in the inventory cost, is superseded. If it takes more than 12 months, even in inventory valuation, that allocable apportionable portion of interest cost can be added. AS 18 related party disclosures. AS 22. AS 22. Deferred taxation, accounting for taxes, timing differences. All these standards are mandatory, so please do be aware and apply. Age 22, there's a challenge, accumulated unabsorbed losses and depreciation. Unabsorbed losses and depreciation. Would it result in deferred taxation? I'm a private limited company. I'm in the second year of my operation. I completed my first year of operation. I have a loss. I filed my return on time. Business loss as well as depreciation. I'm eligible to carry it forward, right? Depreciation can be carried forward even if the return is not filed on time. That's my understanding. So, will that result in a deferred taxation? Yes, it would. It would result in a DTA, timing difference, because this is going to reverse back, and next year when I make profits, I can set it off against my profit and pay lesser tax. Of course, math may become applicable. That's a different issue. So deferred tax assets represented by unabsorbed loss and depreciation can be carried forward only if there is virtual certainty about future profits. Virtual certainty, that's the term they use. In other cases, you can carry forward if there is reasonable certainty. There's a subtle line of demarcation between reasonable and virtual certainty. Virtual certainty, they have clarified that it should be based on reliable, conclusive evidence. Reliable, conclusive evidence. For example, a confirmed export order. You have not been doing well. You have been limiting for 1, 2, 3 years. In the 4th year, probably you went on GEM. You enlisted on GEM, Government C portal. E-market, and finally somebody comes and says that your product is okay, make some changes, we will buy 100 units from you every month. And there's an agreement. So which is reliable, conclusive evidence. Based on that, you will say that you will turn around, make profits in the future, therefore I should be allowed to recognize and carry DTA represented by my unabsorbed losses and depreciation. Technical, but that's very important. The bankers should be aware that many of the corporates, loss-making corporates, were very happy when this deferred taxation came. Because in the earlier format, accumulated losses were lying at the bottommost line of the balance sheet. Accumulated losses. Now where is it? Accumulated losses. Where do you show it? As a bracketed item in reserves and surplus, not as a last item. So the corporates were happy, they could mislead the bankers because DTA, when it is recognized, your loss reduces and you have a new asset called deferred tax asset somewhere in the midriff of the balance sheet. So that was there. So they said, if it's unabsorbed loss and depreciation, no, you have to have virtual certainty. If you are sharing it with the bank, you should pay me, okay?
Okay.
Right. Okay, 22. 26 is intangible assets. What's the treatment of preliminary expenses in the first year when a company is incorporated? Accounting treatment. I would like to have some response. 2 hours of monologue, so younger members should support me. You said, what did you say? Please, louder. Huh? Return of asset? That's only 35 demo. It's not a current asset also. Earlier it used to be shown as under a head called miscellaneous expenditure to the extent not written off for acquisition. Preliminary expenses have to be written off in the year in which they are incurred. Because that does not meet recognition criteria technically under AS 26. It doesn't bring in any, you brought the company into existence, but they're not future benefit. They have to be written off in the first year. Assuming a small company, 1 lakh. They are writing off. What is the tax treatment? You add back preliminary expenses written off 1 lakh and then less allowable preliminary expense under 35D 20,000. Is a tax computation state. What happens at 80,000? Difference 80,000. It is going to be tax claimed in the next 4 years. So therefore that 80,000 will result in a deferred tax asset. 80,000 into your 26% or whatever will result in a deferred tax asset. Whenever we discuss, that's a problem with majority of our membership is saying that tax considerations loom large. It's always tax. So 35D is outside the books. It's like the ICDs. So preliminary expense, earlier there was a head at the balance sheet, miscellaneous expenditure to the extent not written off practice. So there now? No. Because they are called fictitious assets. So you don't have fictitious life, you don't have fictitious wife, why have fictitious asset? There's an old Chennai joke about that. You know, a young CA couple was interviewed. After 1 year of their marriage, CA couple, husband and wife was CA. So the husband was asked, where do you put your wife in the balance sheet of your wife? So they're not very happy in marriage, so he said, I'll definitely put her on the liability side. When I got engaged, it was a contingent liability. When I tied the knot, it became a clear liability and came inside the box. And the interviewer turned to the wife. She was smarter. She said, how do I put my darling husband on the liability side? I'll put him on the asset side, under the head, miscellaneous expenditure to the extent not written off for artist. So that head is not there. So today if she is interviewed, she has no place to put her husband in the balance sheet. So that is 26. So deferred revenue expenditure, all those things are gone in debt. Completely gone in debt. Therefore, that is something which one should be aware of in IS 26. This I think we will move faster. Yeah, IFC reporting is not applicable for small companies and companies turnover of less than 50 crores and borrowing of 25 crores. Otherwise, you need to have that 3-4 sheet of extra reports on internal financial controls. Small company, turnover criteria and borrowing criteria, 50 crores and 55 crores. Not applicable. So what have we, what all have we discussed? We just quickly recap before we go into this. We started by saying the importance of the defining factors are the statutory framework, which we tried to understand, listing the sections of chapter 10. Then we discussed professional pronouncements, the importance of, the format, the schedule 3, which we have discussed. Then, of course, professional pronouncements, in that accounting standards we have run through. Standards and auditing are going to come. And in between, we also discussed CARO 2020, which is specific reporting requirements. That's how we structured the presentation. That is the new term to be used, the schema of the presentation that was like that. And with that, we now move on to standards and auditing and updating. So before that, let us look at some of the audit processes which we are used to, we are doing, or are we doing it now? My experience is that audit has been mostly reduced to a compilation of financial statements. If you ask a student, how far have we progressed in the audit? He or she would say that statements are prepared. This happens everywhere. And the student tends to think that preparation of financial statements is the most important part of the audit. Unfortunately, we are doing it, it's not the auditor's job. But the other aspects are equally important, audit considerations. I remember I would like to quote CA Y.H. Malekam, one of the most revered members of our institute. Seniors would remember him, past president of our institute. He was chairman of Deloitte for a long time. He came to Cochin for 2016-17 when Mr. M.C. Joseph was the chairman of SIRC and we had a conference there. He came at that point of time, computerization was coming forth. And the statement was, talking too much about technology, we are leaving out details of transactions. I repeat, talking too much about technology, we are leaving out details of transactions. This is a statement for all seasons and audits. This is what we are leaving out. So opening balance statement, we must do. What is 510? SA 510? Initial engagements opening, but separate standard and auditing on that. Internal control evaluation and communicating findings to those charged with governance. TCW, those charged with governance. Vouching. Do vouching? Ticking away to glory, we used to say. You can't tick now. You'll have to click on the computer screen. Sorry, you want to say something, please? Yeah, physical vouching. Good, makes sense. Ledger analysis. Verification of assets and liability, including stock verification. For most of the auditors, you know what stock is? Year-end inventory is only an Excel sheet sent by the accounts assistant from the client. He doesn't check whether that exists or not. I will give you an example. Now, see, that's why I say the DC has put a levy, a penalty or rather, debarred an auditor for 3 months and put a penalty of 1 lakh for what? For not getting external confirmation.
Some auditing process they could have done now.
Sorry?
Some auditing process they could have done now.
Which process, sir?
Like, you know, subsequent period verification, something could have done now.
No, but I don't know the full details. I mean, they are not given. The main thing was that it is the case is fully reported. I just glanced through, but then the main reason highlighted is that it failed. Probably subsequent realization did not happen. It would have been a fake receivable or something. The point is very valid. Well taken, because even if you don't have a confirmation, like in bank audit as we do, an NPS subsequent recovery is there, you take a soft stand. Similarly, if subsequent realizations are perfect and bill-to-bill receivables are there, you cannot be penalized for not getting a confirmation. You can take comfort on that. Fully agree with you. Well taken. Verification of assets and liabilities, and then here is comparing financial statements with books of accounts. I may sound very old-fashioned, but how many of us obtain a final signed trial balance, signed somebody at the FM level? And the audit assistants, even the senior assistants, the qualified assistants, interact only at the accountants level. You must go meet the director of finance if you are empowered, if you are bored. And for that you should have the confidence. And also basic knowledge. You should have the required ammunition, I would say. Accounting standard compliance. Schedule 3 compliance information for notes on account. Analytical review, ratio analysis, trend analysis. Caro points, informed reporting, etc. And as far as SS are concerned, the new preface came in 2008. The whole story changed. And we have SQCs now and engagement standards. SQC, we have as of now only one, but they are issuing more standards now. SQC 1 standard and quality control 1. Engagement standards are divided into standards on auditing, standards on review engagement, standards on assurance engagement, and standard on related services. That's what SIR asked. SRS 4410. Engagements to compile financial information. Why comply with standards is because we need to expedite audits in accordance with generally accepted auditing practices. We utilize the resources effectively, the time factor, the very less number of students we have. With the new scheme again, 2-year articleship and articles, they would join only after completing both groups of intermediate and orientation and all that. The number of students is substantially lesser and they will be very choosy. It is not you and me, but to speak to the members, I should say that students will be very choosy. I remember a member telling me, a student came for interview in my office and he asked me a few questions. I checked him out. So what is wrong in the student asking questions? When it's a marriage for 2 years, he should know what kind of place is this. How much is the stipend that I'm going to get? Do you have the culture of paying a stipend? The stipend has also been increased. Students, shut your ears for a minute. We have been basking in the glory of cheap labor. Even now the rates are not very high. I thought you'll get a clap from there. No need. So that is how things are. Things are going to change and we are refusing to change. If you look at the whole of South India, if you take, why is that many of the legacy firms have disintegrated and disappeared? Or they do not have any good audits now. There has been disputes. I can give numbers, firms in Chennai with my limited experience. From the days we were doing articles. Chennai should surely agree with me. They have disappeared, legacy firms, who were respected, who had the number one auditors. Of course, the influx and the impact of Big Four has had a huge effect, but then why did the basic reason? is that they fail to transform. They fail to adapt. They fail to imbibe technology. They fail to infuse fresh blood, young partners into the firm. Any number of reasons. Any well-meaning firm for that matter. And sole practitioners also, let me tell you, is becoming increasingly difficult. There's no succession planning. Even at the age of 70, we tend to think that everything will go on for 20 years. And something happens, then what happens is the files are gone. If there's no successor in the family. All to be discussed on different platforms. I'm saying this because the legacy firms disappeared mainly everywhere. Corporates disappeared. In a failure story we talk about. Where is the CD company now? We give a lot of examples. Why did Ambassador and Hindustan Motors and Fiat die? At least the Fiat models died. They thought that there are no further model, in spite of having so many models. In our profession, also, many of us. And it was very belatedly this year that our firm has started using an audit software. I went for this World Congress of Accountants in Mumbai. I went to the exhibition area. Anyone attended the World Congress of Accountants? It was a gathering of 6,500 chartered accountants from across the globe in the Geo World Convention Center in BKC, Andacola Conference. Huge conference and beautiful facility. The facility management is so good. Even the cleaning boys and girls look like film stars. Well groomed, well behaved. In the exhibition area we had a small football court, a cricket pitch and all, very good. So I went to a shop, went to a what we call it as the exhibition area, one stall. Ashore AI, maybe many of you are using it. We started using the software where our work becomes defensible, much easier, substantially much better. Our team has been trained on this. My partner is taking care of. I have not gone really in depth on that. So it's high time that we started leveraging on technology, reducing the routine work and all those things. So transformation is the key. Therefore, resources, your CPE, ensure quality control, disproving charges of negligence to face and pass peer review. Incidentally, we got our second round of peer review done. Yesterday afternoon, when I came back after a client meeting, that is there on the table, the peer review certificate. The peer reviewer is very closely known to me, and she is much junior to me in the profession. So I told her, don't take into consideration all that. Do it very impersonally, very critically, and ask all the relevant questions. And I think we probably would have got 85% marks. 15% is still there. And certificate, again I'll tell you something. When we got it for the first time, I told my partners, we should market this. Not by advertising in the newspaper. We send a mail to our clients. We are not doing any branding. We sent a mail to our clients. The subject of the mail was, we are recognized. We have been recognized. We are happy to inform you, proud to inform you that we have been granted the peer review certificate by the Institute of Chartered Accountants of India, which is referred to as the hallmark of professional excellence. Acknowledging that the processes of the firm is mature enough in servicing the clients and complying with the best standards, best industry practices. Thank you for your support. Let's say a little bit of branding. And many of them replied, probably even not knowing what it is, congratulations. But it's branding. And it's also displayed in the reception area of my office. It is the peer review certificate. The early one was colorful. Yesterday my partner said, this is just a white sheet of paper, laminated. Those who got it second time would know. I said, let's put a border and make it visible at the reception. So that kind of branding, we are allowed to have a website. How many of us have? We are allowed to have a brochure. Not to be sold, not to be standing on Nugabang High Road and distributing it. But when clients come, we should present ourselves better. So peer review is very important. And lastly, this is a point I've been discussing earlier. It's a very important reason is today it is part of the statute book. When the institute is issuing accounting standards and standards auditing, not recognized at the Companies Act, senior members would surely remember. We said the standards are fine, but they lack statutory teeth. They can't bite. Today both accounting standards and auditing standards have statutory teeth. Accounting standards under section 133 in chapter 9 and accounting auditing standards under 143 under chapter 10. So we have to comply with standards. Look at this. This is what Mr. Injati Srinivas said, the former MCA secretary. A very shameful remark. We do not expect the auditors to see a needle in a haystack. You know what a haystack is, youngsters? A gramathra board, where you have the cows are reared. What's that? We call it Maikol. What is that Tamil? Maikol. They just have a huge stem or a tree, on that the Maikol will be hacked. And then pull out as and when required. They're called the haystack. The auditors need not find a needle in a haystack, but please see the elephant in the room. And today that term is very frequently used. Auditors fail to see the elephant in the room.
Sir, go back to that. Former MCA secretary made a cutting remark by making a comment right there. I don't agree with the comment. You have the ability to get the needle in the head based on
They should have the
we have the ability, and we do that also, in pulling out what is really the focal point or specific point, what is really inside, we are able to pick it up. His comment or his observation or anything, I object to that. So he is trying to depict, we don't even see elephant in the room.
I understand what you're trying to say, but sir, unfortunately, in every corporate failure which has happened in India, across the globe, there have been huge audit lapses. What happened in ILNFs? I can give you n number of examples. It is continuing to happen. What is happening in Byju's, which is a Kerala promoter? They have created a scare there. I'm not straying from the point, a lot of things to be discussed here. I feel that is largely justified. I'm not contesting one-to-one. Not that your viewpoint is your viewpoint. My viewpoint is slightly different because the regulator has been seeing this, what is the auditor doing. There are glaring instances which the auditor failed to recognize and saying that is true. 305-page report of NFRA in ILNF's case, where Deloitte paid the auditors. When somebody, I quoted this and a partner came and said, it's not fair information, then it is in public domain. And 305-page report, it is the crux of the report is two things, which is the next slide. The auditor failed to exercise professional skepticism. They didn't ask relevant questions, they took things for granted. The second point they said was, this is what I have been teaching 20 years in the first class on auditing. And also they failed to obtain dash evidence. Sufficient appropriate evidence. So many of the auditors are, with due respect to your viewpoint, many of the auditors fail to see the elephant in the room. They take audits for granted. For huge fees they take, there are no audit process, there are no documents, n number of exams. And we are seeing this in the reports every day. So he as a regulator is warning the profession. Again, that's the point I want to say in the next slide. Audit is not only a watchdog, not a blood dog. The decision was in Kingston Cotton Mills case delivered in 1872. So Mohan Levy wrote in Business Line again saying that the profession has been holding on, the members of the profession is holding on to Kingston Cotton Mills case as an insurance policy, as a shield for not doing what they should have done in an audit. I fully agree with it. Where the judge said that the audit is only a watchdog, not a blood dog. The regulatory amendment has changed. Of course, leave out the public expectation gap, that is increasing actually. Even with the public getting more educated, expectation gap is increasing. But here is a case where a lot of failures, the auditors completely failed to bring out the cat. So finally, Amarjit Chopra ji once said, in his own style, "Arey Baba, you talk about watchdog, blood dog. Anyway, we are dogs, at least bark here." This is not happening, sir. This is a viewpoint. I agree with your viewpoint. A harsh statement should have been made, but he is a little too candid to come out and say that you guys are not doing it. That is what Modi ji said. 2017, 1st July. Today it is CA Day, it is Doctor's Day, it is GST Day. Modi ji is invited when Nilesh becomes the president. He came up and said every time the president or the minister comes up and says that institutes a partner in nation building, all those good things, always a pat on the back. Modi ji also gave a knock on the head, saying that you guys be careful. Look at the GST regularities that are happening in Gujarat and Mumbai. Our members are party to it. Fake invoices and things like that. PMLA. Anti-money laundering. So the regulator is sometimes justified in saying that what is the point saying that you are a great profession? You were formed before India became a republic. All that is good. But where are we now?
Sir, small point
Yeah.
here. What the institute is mentioned either Gujarat or whatever, they are not going to depend anybody. That was the role performed by an individual. But this is what we are talking about is the role as a chartered accountant or auditor.
Auditor.
The CA can do so many things,
Yeah.
like any human being. But as an auditor, we are expected to do certain standards. Whatever suggestions, things you mentioned, that was not the role of an auditor trade. It was an individual human being tempted by various things.
That's about the GST you're talking about.
Whatever it is.
No, specifically I'm asking you.
Money laundering.
Specifically, money laundering, yeah.
Yeah, it is not that these as an auditor he is doing. See, this is what we are concerned about is the auditing profession. As you rightly pointed out, a 5 crore company is different from a 500 crore company. You cannot apply the same matchstick of finding a small elephant or a big elephant in the same group. That's the concern.
Yeah, I agree. I mean, I was probably went a little this thing because from the auditor we are saying that what Morji said is not specifically with reference to the audit. There are black sheets, like in every profession, there are black sheets that are going to cast them. And you know what happened? 132 was the last section of the Companies Act which was notified. In Afra, the institute fought tooth and nail not to get that enacted because we are a regulator, we don't want a super regulator. And 2017 Morji's speech was a clear indication that 132 will be enacted and there will be super regulator. And we are under the lens than ever before we are under the lens. Not without reason. I mean, not an argument, but I fully agree that, the auditor's role is different. Sometimes even an in-house chartered accountant would help a company to do some different and he's not an auditor. But then again, the PMO or the PM or that kind of that level, they see the chartered accountant as a chartered accountant, not essentially just in the confined role of an auditor. So SA 200 is a takeoff standard where it talks about professional skepticism, asking questions, relevant questions, questioning mind, etc., etc. That's very, very important. Not taking people, explanations, documents for granted. Audit evidence, again, he has to be alert to situations where the circumstances suggest a need for audit procedures in addition to those required by SA. More deeper doubt, drills and drills, we have to go deep down. All that is what is required in SA 200. It's a takeoff standard. This is a standard which says that the auditor should collect evidence, which is expounded in SA 500. This says that the auditor should plan his audit, which is expounded in SA 300. It says that the auditor should document his work properly, expounded in SA 230 and so on. 210 is something which we are not compliant, many of us. Getting a written letter of engagement, LOE, letter of engagement, before we start the audit. Objective and scope, responsibility of the auditor, responsibility to management. The reference to expected form and contents of the report, SA 210, is called audit engagement letter. We call it LOE in our office, letter of engagement. SA 230 audit documentation. Can you read this? Those sitting in the background. Not documented, not done. The standard says, now this standard is done away with the requirement of permanent file and current file. The crux of the standard is saying that the auditor's documentation should be sufficient to establish that has done the audit properly. That's a macro statement, right? What is this properly? In compliance with the applicable standards in auditing. That's very important. Even for a layman to understand, that to that extent they stretch. To a layman to understand that the audit has been done properly, sufficient documentation.
The qualified auditor is not there.
Sorry?
The documentation is such that the qualified auditor can find out some work has been done. It is not documented.
Yeah, no, quality audit, the standard says even a layman. To that extent they have extended. No, qualified auditor or regulator may not be qualified auditor, but then the wording used is this. Ideally what he said is right. But they are going further on this. So again, thick box files, not necessary, it can be in soft copy form also. Debtors confirmations, creditors confirmations, bank statements, all those things, bank confirmations. But of course, when you verify the fixed deposit receipt, sometimes, we are just finalizing audit where there's a deposit 26 crores of FDRs. We physically verified and got a bank confirmation. Certificates were there, surprisingly, all the certificates were there, they had beautiful tabulation of that. It's a company which had a bumper profit last year because of the price fluctuation in their product, and they have those reserves. That can't be, of course, the original has to be verified, and then you could have taken, you could take copies of that and document it, scan copies, not essentially hard copy. It's less of paper these days. Planning and audit of financial statements, now again SA300, is two things. One is an overall audit strategy, two is an execution program, detailed audit plan. How many of us use an audit program for an audit? Vast majority of us do not use an audit program. It is on a mental plan that we work. If there is a properly filled up audit program, that itself is proof that you have covered all the areas which have been covered. Audit program is a must. There are downloadable formats. It's just googling up and getting it. Or in my mail, if you have received, it was there. It is an audit kit. Containing all these documents, letter of engagement, letter of representation, audit planning memorandum. We call it APM in our office. That's the first part of it, overall audit strategy. It's just a two-pager saying that what are the areas to be covered, the time frame, rough time frame, focus areas, etc., etc. And finally it concludes with the note saying that perform the audit in compliance with the detailed audit program, which is again the student has to carry in the course of an audit. Separate for, again, audit program cannot be standardized. I am doing the audit of a manufacturing company today, and tomorrow I am doing the audit of online. I am doing the audit of Uber or a Zomato. How can this audit program be relevant? Or a stockbroker. So it has to be customized on a case-to-case basis. Very important. So do plan the audit, have an audit planning memorandum, and have an audit program as detailed as possible. And do fill it up also. After the audit is over, then if it is remaining empty, there is no point. We ask our students to do an end of day procedure, EOD. End of day thing they are supposed to do. Yesterday, a student was leaving for exam, so I was just finalizing in the evening, so I asked for, they said this has work which has been done. Then I asked for the audit program. Then there's a frown on the face. The junior started uttering something and all that. He said, so some points should be filled up. I said, do it now. If you have done it, what is the send out in the room? They filled it up and gave it. I may sound like a headmaster. SA 315 is a very important standard. Now what happens is knowledge of business in the case of an audit. The auditor should have sufficient knowledge about the business of the entity. In fact, there are three standards which have been subsumed into SA 315. When it was AAS, the original name was SAP, Standard Auditing Practices. Then became AAS, Auditing and Assurance Standards. Now reclassification SA. Somebody liked to me and said, earlier they were sapping our intelligence, SAP. Now they are making an ass out of ourselves. And now whether we like it or not, the new name is SA, Standards and Auditing. And so, study and evaluation of internal controls, knowledge of business, auditing in a computerized information system environment. These three standards have been combined into this one. The point is, you should, in order to assess audit risk properly, you should understand the entity and its environment, the business that it's doing. Entity-specific knowledge, industry-specific knowledge, and an understanding of the macroeconomic environment. For example, a few years back when real estate was completely down, that happened in China. Now what's the present situation? The last 1 year has seen a lot of major crashes in China. Buildings have been demolished because of the glut in the overseas, in the real estate market. The market has been totally down. So finally, when you do inventory valuation of finished apartments, cost or net realizable value, whichever is lower, then you should be aware that the net realizable value is substantially less than what probably it used to be 1 year back or 2 years back. It could be a temporary feature, it is cyclical, but as on 31st March 20 dash, what is it? That's knowledge is very, very important. I used to tell wherever I presented about 12, 13 years back, not now. When I was traveling, come back to office and see a new assistant. And so then she would probably stand up and say, "Sir, I'm a new person." What's your name? Ashwati. What are you doing? I'm doing motion. Which client? 1 minute. What is their business? Business, I'm not too sure. This is what the standard is. So I'm confessing something which happened, that doesn't happen now. And our audit program has a particular clause saying that prepare a detailed note on the business of the client and new lines of business if any. A housing finance company, for example, would have started two-wheeler financing or motor vehicle financing. So there is a deviation, so you have to have new ways of dealing with the audit as well. It's a new line of business. Rahman, what time do we close? No problem for you. They will ask them. You give dinner? No, snacks were heavy enough. Good enough, I hope. Yeah, that's it. So, without understanding the detail, what is audit risk? A student from Tamil Nadu in ICAI, and now political English, don't get me wrong, was asked this question, and he said, it is very risky to be the auditor of the CM of Tamil Nadu. One former CM had slapped the auditor. That is stories like that. That's not audit risk. What is audit risk? Audit risk is the risk of expressing an inappropriate opinion. We are saying true and fair when there are a lot of embedded inherent problems like misstatements, omissions, all those things. You are still saying that gives a true and fair view. True and fair is what? What's your name? Arun. True and fair is saying that Arun is a good boy. That's a clear cheat. Sometimes I say except for Arun is a good boy. That's a qualified opinion. You okay using your name? The third one is Aruna. I will not express opinion. You check with somebody else. I'm washing my hands. That is disclaimer. Finally, you don't want to hear this, close your ears. Aruna is a bad boy. Or Aruna himself saying, Aruna is not a good boy. That is, does not give a true and fair view. That is as good as that. The opinion is the same as like you ask about. We get a lot of inquiries. Sometimes a friend calls from my village. They're saying that Jomon, there was a girl called so and so who did articles in the office. There's a marriage proposal. Not for me, not get me wrong. So I said, how is her? How is she? How the family? How do you know about her? In some cases, like we say, she's very good. Like if I had a son, I would get her married to my son. The second one is except for. And you also check with somebody. Third one is don't ask me. Fourth one is Veda. Muttida, in case of Muttida. Don't laugh, it can happen to you also. Okay, so that is understanding the entity and environment proper. To be audit risk is expressing an inappropriate opinion. We are saying everything is fine, then it's not so. We have heard that somebody goes for a medical checkup and doctor says that you are in the pink of your health. And coming back, he collapses in this thing. It can happen. There is some test fail. It can happen. So that is very important. SA 315. Audit evidence. Anything that is relevant to establish your assertions in the audit is evidence. Visual evidence. They ask, we constructed a new building. Where is that building? Building is in the air. Again, in this recent audit, I went for the factor visit. They have a 3,600, 7,000 plus acre palm oil estate, oil palm estate. And that capitalized, the head office had seen that there's a capitalization of 50 lakhs of particular. I went to the factory and found that it's not even installed. It is lying there with the plastic cover and the foundation is being done. So from instead of capitalizing it, what do we do it? We call it capital work in progress. Small things, I'm just giving you right examples. So visiting the site is very important. When we send our students, tell them don't sit in the AC cabin, which is overlooking the shop floor. Rather, go down, see what the process is. We used to do that. As a younger chartered accountant, I used to go and do oversee physical verification. And there's one factory where there's a carbon black was used. So you used to go in a denim jeans and a black t-shirt. Not in the full sleeve which a CSW is supposed to. Grooming is very important. In your GMCS they tell you, groom yourself properly. You should do pedicure, manicure and all that. So that is seriously, it is part of the book, sir. MCS, Management and Communication School. You know what the new name is? Members may not know. AICITSS, Advanced Integrated Course on Information Technology and Soft Skills. Okay, this is a very, very important standard evidence, visual evidence, written evidence, oral evidence. Do get that to the extent the sufficient appropriate evidence. Sufficient means quantity. Appropriate is relevance and quality. You have 5 thick box files, all junk. Instead of you have 3 folders in your laptop or in your server. Again, everything should be on the server. Students, again, sometimes you have your desktop as this thing, but always stored in the server. It should be connected to the server. SA 501, so this one point is very important. In addition to having a standard on 500, this is an offshoot of 500, where they say that specific consideration for selected items. 3 items: inventory, litigation, settlement. I'll conclude, I will just start with inventory. How many of us physically oversee, or rather send our assistant for physical verification, or do physical verification during the course of the audit? Very few. Bank audit we used to do for physical verification. A lot of goof-ups used to happen. A lot of stories because paucity of time is skipping all that. So the standard requires the auditor to make sure that there is physical inventory. It exists. From a banker's perspective again, it exists. It is in good condition. I will tell you, when we went for the bank audit in Canara Bank on branch, Avenue Road branch, that was 87 December end. That was one of my first outstation audits. From Chennai went to Bangalore. We went to a company which is called Gogoldas Fashions, which finally went Bangalore. We went for stock verification, and stock was supposed to be export quality garments. We wanted to visit the godown. Manager was a little reluctant. Assistant manager said that place is very congested, let us not go. Immediately we said we have to go. And finally we found that it's under double lock and key. So Kamath was the assistant, and Kamath finally opened it. Like in movies, they show all the houses around. He opened. And export quality garments were all in very bad condition. Those days they used to do the needle in the haystack, the steel needle or whatever. They had all rusted. So it's all rejected material lying there, and the exposure was in those days 10-15 crores. NPA was not there in those days. NPA came only in 92. So then they said provisioning has to be made and all those things we said. So then coming back, incidentally, the manager asked this question, the assistant manager. He went in his Fiat car. Kamath, is it sufficiently insured? Yes sir, it's fully insured. Then the manager said, then one small this thing will do. You know what he said? Set it on fire and claim insurance. You know what my senior said? That's very important. He is now in Botswana, Gobi. He said, Joe, make sure, go and verify the insurance register. And when he found that the insurance is not renewed for 2 years. Gobi was so happy, he went into the manager's cabin and said, Mr. Kenny, if you had done one small this thing, you would have been one big this thing. It happened in 87, 88 January. No, that's how I still remember. See, his question, his acumen, and it was quite good. Immediately, and he said, in my years, we are sitting in the back seat. Go check whether the insurance is good. You should become seniors like that. Gobi should be sneezing sitting in Botswana. So inventory aspect, you should set and make sure that it exists and it's in good condition and it is properly valued, AS2 valuation. Defective material, poor quality material, rejected material cannot be valued at full value. Maybe you put what is a realizable value, whether it can be sold in the scrap market, etc., etc. That you must do. Again, one more example. During COVID time, a friend of mine asked me whether we can do a physical verification. Not by a client. He said they are audited by a multinational firm and they are in Pune. And this unit was taken over by company, I'll tell you, it's a listed company, Indigo Paints. You know Indigo, everyone knows Indigo. Why? Zebra and Dhoni, the Indigo Paint company. So they had taken over this unit, and that became, instead of, it was merged, and that became the Kerala unit of Indigo Paint. And they didn't want to come from Pune all the way, risking their lives and spending money. So they asked the company to outsource verification to us. And the first instruction to my partner, they insisted one partner and 3 assistants. The first thing they insisted was the partner and the student should take a group fee in front of the factory. And it's a part of their audit documentation. Right? Because proof that they actually physically been there. Then the entire this thing was live video stream and seen by an audit manager sitting in Pune. And I was asking questions real time online. At 3 o'clock they said we are done. Now pick up 3 items of raw materials and 3 items of finished goods and report. The report had to be done sent the very next day. We did that. They have very good systems. They have SAP and very good system. Hardly any discrepancy to be reported. And there again, one more thing I'll tell you, not for the students. And he's a friend of mine, so sometimes we would start. We looked at the scope of the work. I asked my partner to look at the scope of the reports to be issued. It was very, very extensive. Not exhaustive, extensive reporting we had to do. Physically, they had to go spend the full day. We said we quoted a certain fee. And he said, it's quite high. I said, sir, there's a lot of reports to be issued. And he agreed. I said, no credit. He's my friend, that's different. We recently went for a tour and we came back together into a place called Nelliyapadi. So he said, sir, no credit. And the bill was sent along with this thing, and it was left. It came in 1 hour. How many of them do that? We are scared to court because he's a friend. Commission is commission. Charge is different. So it's a 501 very important. External confirmation. We have been talking about the salaries at particular points. Wherever possible, receivables, payables, bank balances. And confirmation is not just about balances. It is also about custody of documents. To do for an audit, you say that where is the original title deed? You have got land, right? Well, it's with the bank. We have equitable mortgage. We put it to the bank for term loan as collateral. Get from the bank a confirmation that it is with them. The original is with the property number, so and survey number, so and so, and the extent, full detail. They normally give. Similarly, goods lying with the subcontractor, outsourced person. 50 units of ours is lying with the subcontractor. Get a confirmation. So it's not just getting a bank balance confirmation. When we talk about external confirmations, the only thinking is that get a bank confirmation. And sometimes they say 5 of our accounts are inoperative, so that we will not get. Be careful. Inoperative account we must. 510 initial audit engagements, opening balances. Now this opening balance checking is normally seen as a clerical thing where we make sure that previous year's schedules, sub-schedules, groupings, it is brought forward properly into current year's field. But it's not just that. See, this year again, first year, we got an audit for shipyard, say rotation, where all the assistance not there. Land 2 crores. Clerical it is correct. I'm giving the figures, not the actual figures. But where are the documents? They've been audited by another firm for 10 years, but we are doing it for the first time. Let's have a copy of that. Where is the original? Vehicles. So how many vehicles are? What is it? How many pickup lorries, trucks? How many cars? Where are the RC books? You know, it's already there. So it's not a transaction during the year. It's a brought forward item from the previous year. You should ensure that receivables, payables, they actually exist. They are receivable, they are payable, etc. etc. Very important. SF510 analytical procedures, ratio analysis, trend analysis, etc. And today, with the revised Schedule 3, we are forced to do that. More than 25% the company is self-expected to give an explanation. And in Caro, we are referring this for astrology. 530 audit sampling. Now, most of us are doing judgment sampling. Typically, we send a student with an instruction, go do vouching. Go do vouching. So he asks, which all months? Check which all months we did last year. Last year was August and November. So this year you do September and February. This is judgment sampling. Simply put, this is not defensible. How did you pick your sample? The DC or the LFRA would ask it. Not defensible. But essentially, till last year, I was also confessing. But the new software being used, the sample is picked up by the software without human judgment or this. I'll quote again an interesting story by Mr. Nityananda from Bangalore, the former Central Council member. He is no more. 2 years back, or 1 year back, he died. Nityananda sir came for a presentation of standards and auditing, and he was talking about the sampling. So the student from Bangalore was sent by the boss, you go do vouching. Boss is always busy, right? So go do vouching, which all months? He said in August and Jan. The student comes back in 1 hour. I said, I finished vouching. So fast. Sir, there are no vouchers in those 2 months. Because the mango pulp making company, so the mangoes get ripe in these 2 months, it's a seasonal thing. After the pulp is sold in last time, there's only a watchman sitting there. So this can happen. This is judgment error, human judgment. As a system again, I don't know whether certification will be done or not. If system makes a mistake, we can say that's not me, the system at least. No, but again, certification, seasonal things. Earlier in tourism projects, when we are doing audit as well as when we are doing financial projection for a project report, we used to make a difference between season and off season. Because Kerala, we have heavy monsoons. I'm being Kerala specific. So monsoon was supposed to be off season. Now, trust me, monsoon has a large crowd because people come and enjoy the rain. They chase the rain, chasing the monsoon. So there's no season, off season now in Kerala. So it can change. So data has to be stratified also. Statistical sampling essentially can change or expects a sample to be the universe of the population to be stratified to have the best possible representative sample on a random basis. Going concern is a big concern. If the company is almost hitting a dead end, if there are indications, the auditor has to very carefully analyze that and make sure that the required aspects have been done, including non-current assets held for sale and all that. SA 580, return representations. LOR, the term they have used is management representation letter. Get everything in writing. The company says that we have not dealt with in crypto transactions. Get it in writing. These are the bank accounts which you are operating. We do not have any other bank account. Get it in writing. We are not covered by the provisions of CSR under section 135. A lot of things, all the provisions have been made. Loans and advances would realize, or we have made provision for possible bad debts, etc., etc. All that is writing, and this is not substitute for audit evidence. This is only additional comfort that the auditor provides. You cannot say that I obtained a letter of representation and signed the balance sheet. No. You have to do all the control, compliance procedures, substantive procedures, and do it. We come to the reporting, forming an opinion. So, all standard, you leave it now. Title, addressee, opinion comes first. Basis for opinion. Sometimes it's not the base for opinion. Basis for qualified opinion. Basis for disclaimer of opinion. Basis for adverse opinion. And how do we give the opinion today? If there is a qualified opinion, except for matters mentioned in basis for qualified opinion paragraph, the financial statement give or to one. Going concern, if it is at stake, we have to highlight key audit matters only for listed companies now. Management responsibilities, auditors' responsibilities, other reporting responsibilities. We talk about 143S, GH and all that. Of course, Caro, we also refer there, give us a separate report. Signature, date, place, and what is that I've left out? UDIN. UDIN is a wonderful thing. It insulates us from unscrupulous, unorganized practitioners, non-professionals. But very important that you have to find out to who, which phone the OTP comes. It should come to your phone only. I stop with that. Key audit matters will jump. Opinion, different opinions we have sent. Remember his name, Arun is his name. Arun has been very attentive, thank you. 706 is something called the emphasis of matter paragraph. the auditor feels that there is something which he has to highlight and tell the users of financial statements, but it is not so intense or not grave enough to have a qualification. Therefore, he would say something in emphasis of matter paragraph and conclude by saying, our opinion in this matter is not modified. That is not a qualified opinion. Sometimes some of the debt rates have not been confirmed, etc., etc. A lot of examples which should be given in this particular standard on where EOM has to be mentioned. Audit training, yeah, this is a rubber plantation camera, looks like, okay. You can skip all that and finally come to this, very demanding situation. And this is a slide you have been waiting for. So the trail, those who have started using Tally with the audit trail. Actually, it's not audit trail, it's accounting trail. Trail of the accountant. Audit trail comes much later. And the Tally, the icon calls it Tally EL. The other term they use for audit trail is edit log. So if it is enabled, it will tell anybody who goes to get the Tally data, or Tally the financial accounting data rather, who made the change, when it was made, and what fields were changed, the amount involved. So since it's under the Companies Act, membership is not much worried. Imagine it was under the Income Tax Act. The members would have started becoming really scared. Now, I'll give you this example. What happens is, we are finalizing the audits of March 23, right? 22-23 now. During the course of the audit, a lot of entries, correction entries, year-end entries, and entries could happen. But then your clock has already started on 1st April 23 in the edit log. Now you have to go back and correct the opening balances. That is where the challenge is. And the regulator will surely, the future is going to be data for everyone. So there it is not now today if there is a real estate transaction of more than 30 lakhs. I mean 30 lakhs is illegal. The sub-registrar has to send a report to the income tax. Do you know that, no? In mobile property transaction, the sub-registrar would send a report. Now, technology will enable that he doesn't have to send a report. There will be an auto pop-up in all the concerned departments. And this Tally, and again, Tally is living large. Zoho is already enabled. So if you have customized software, make sure that it is enabled and it is not what they use it as. The term they have used is not being tampered during there or disabled during the etc. Very, very tricky situation in the Indian life. Now we'll come to the last point of it before that. Point we were discussing on audit trail is, I'm sorry, yeah, this is a clause what has to be there. The auditor's rules have not been amended, only the accounting rules have been deferred. Therefore, we have to give under other legal and regulatory requirements. As provided in Rule 3.1 of the Company's Accounts Rules is applicable for the company only with effect from 1st April 2023. Reporting under this clause is not applicable. This is what the clarification the institute has given. Are you getting the point clear? Audit trail is a requirement under section 128, which is chapter 9, Companies Accounts Rules. There they have deferred it to 1423. The corresponding amendment has not been made in Rule 11G of the Audit and Auditors Rules. Therefore, unfortunately, what could have been awarded in the notification, we are not reporting. So this is only new thing as far as 22-23 is concerned. Everything else is like what we have done. Whether we have done it right in 21-22, if not, from your new learnings, probably from the insights we have gained through this presentation and the slide which should be shared, those who wish, we have to apply this in detail and make sure that we comply with all the requirements and that they are not taken to task. So with that, thank all of you for being a wonderful audience, for being glued for the relevant questions which have been asked, for some bit of viewpoint which resulted in argument, nothing personal. Have a wonderful time, and to be in Brahmaya Hall is a great feeling. Particularly standing on this desk, we have attended classes here, so all that, it's a great feeling. So thank you once again. In absentia, I thank Chairman Pandara, Secretary, and all of them for calling me back home to Chennai and you try to remember us. May God bless every one of you. Thank you.
Any questions? Any questions to Juman sir?
Yeah, one question. What happens if we don't round the figures, the absolute figures, whether to be wrong?
What if we hold?
If we give full absolute figure in the financial statement, without rounding it down.
Yeah, it's a violation. Whether they'll take action for that or not, because it says that shall be rounded off. Earlier it was may be rounded off. That's why I said my first point was this has been made mandatory. Rounding off is mandatory.
Because again for MCA purpose, we have to give absolute figure again. Look, can we sign two balances like this absolute figure?
No, you don't have to sign. That's for income tax upload you're talking about. No, the AOC form.
Even AOC form.
AOC for upload, yeah.
Even for income tax also.
Yeah, that you don't have to sign, no. That is the that you upload this. You sign. You don't have to sign. You sign only the rounded off ones.
Because rounding it's really difficult. Sometimes the difference of 1 rupee or 1 paisa, whatever it is.
Materiality, sir. Leave it. It's all good. No, it happens. The student would come up and say the balance sheet doesn't stand. In a big company, they say there's a difference of 17 rupees. So that's because of rounding on. That can happen. You can round it up.
Yeah. In case of in audit report, they are asking pending litigation which is affecting the impacting the financial position of the company. Which type of litigation they are referring to? What kind of litigation?
Yeah, pending litigation is that, for example, if there is a demand from the income tax, which is under dispute, you have filed a penalty. That can happen. There is a
like any suit filed against a customer to recover the money.
Not only that, there is probably criminal case on the company, criminal listing on the company on some property enforcement or something, and which can result in a penalty or a levy by.
It is against the company, not by the company.
Not by the company. No, that is where only have the financial impact. The negative impact is what they are looking at, not what they final gain. That's a contingent gain actually. If at all that happens favorably for the company.
Ratios, you said it is already given the guidance for I didn't find it from anywhere.
Yeah.
Regarding it.
It is given. In fact, I had a doubt, and in the afternoon I checked with my partner, and he sent me a WhatsApp, including the formula they have given.
Can we start doing the signature by DSC or the balance sheet, like without doing physically?
There's no prohibition.
There's no problem. We can do it.
Recently, I asked for no objection from an auditor. It was smaller town, Kottayam. Those who called this Abrimala would know. Kottayam. So he sent this letter digitally signed, scanning, not physically.
India's applicability for unlisted capital.
Yeah, 250 crores, net worth of 250 crores or more.
Last year.
That has not been changed.
That is,
Yeah, you asked this question. So that is as of 31/3/22 you have to consider. 22/23 when you do the opening net worth of exceeding 250 crores or more. Counting size. India is all listed companies, irrespective of size. Because Kerala, earlier the Bombay Stock Exchange threshold limit was only 3 crores. Kerala, we have a lot of listed companies with paid up capital 6 crores, 7 crores. Listed company, irrespective of size, fully applicable in the is. Unlisted companies with net worth exceed 250 crores or more.
even if it is private limited, public limited.
Yeah, no differentiation. No differentiation. Private limited also I look up. 50 crores in net worth.
Thank you.
Thank you very much, Doman sir. That was a lucid and fun to the session and at the same time a to the point presentation. May I now request Sri Kumar sir to give us closing remarks and word of thanks.
Sri Kumar, incidentally, I introduced him and recognized him, his presence with so much of happiness and pride. Sri Kumar is triple qualified. He is a CA, CW and CS. I opted to get into banking. So he was in the Treasury Department in Mumbai. So I went to Mumbai, I went and hunted him down. Now he is with the regional office in There is a same others one. So you're next door.
Next one.
Thank you, Srimo. Please.
Good evening, all of you. Thank you, respected Jomon, members of the institute, and all my dear professional colleagues. It gives me a great pleasure to be part of this group and listen to such an inspiring speech on the topic, which actually, though I had not been in touch, it took me back to those days when we almost 30 years ago. It took me back on a Malaram Ninevugal journey to those years when we did company audits together, and so many things has changed after that. We were all in that old, as he said, so many examples which he said, which we could, as a senior in this thing, I could relate to my experience, though presently my profile of working is different. But I am very happy that he took pains to explain with reference to banking also. Really thank him for that. And the thing is, the 3 hours have passed without even me feeling that it has passed. That is one art of Jomon, I would say. Even in the good old days, we used to spend hours and hours together without even knowing that the time has passed. So thank you, Jomon, for really making this very, very interesting session. I am sure all the participants would have enjoyed, at the same time acquired a lot of wealth of knowledge, which he has really made it simple. Thank you all, thank you all, thank you.
Thank you, Sri Kumar sir. With that, we have come to the conclusion of today's session. Thank you, one and all, for your valuable time and questions. Thank you.